I spent a ton of time, effort, and money to put this thing together, and I can bet money on the fact that this full course will be more worth than any amount of cash you spend on a trading course. This is by far the most comprehensive guide you will get to make your first 3-figure day in 14 days trading, 4 figures in 6 months, and 5 figures consistently. This is the exact blueprint I use to create a profitable trading system for my members to help them scale to tens of thousands of dollars in a day in profits. JP made $32,000 trading with these systems, and Citi, who is a mother of two, busy as hell, but made $13,000 just by implementing the systems I'm about to share with you in this video. Not to forget Zul, who has made over $50,000 in pure, unadulterated profits from using this. And I'm giving it all away for free in this full course. Now, if you don't know who I am, my name is Nick, and I've turned $100,000 into over $2.1 million in profits trading live in front of thousands daily using the systems I'm about to share with you. I'll go through the thought process behind maximizing profits and minimizing risk, the exact setups I look for while trading live in the markets with thousands of people tracking my every trade and move, actual examples of setups that have been extremely profitable, that have appeared day in and day out in the markets, and last but not least, how to put all this information together so that you can create your own profitable trading system. The first module is going to be about mindset, because if you want to start making those 5 figures trading days, you can't be thinking the same you've been thinking the entire time. I'm going to show you how to change your frequency to consistently take profitable trades and fill up your bank account. As ridiculous as it sounds, without the mindset shifts, I wouldn't be where I am today. So sit tight, buckle up, and let's print some cash. Welcome to the very first video of the Directional Accuracy Challenge. Today we will go through what I believe is the most crucial part of being a profitable trader, the mindset. Most people don't know how or what to think and behave because no one is watching them or telling them what to do. So in this video, I will bring you through how a profitable trader's journey should look like. So let's get started. Welcome to the Directional Accuracy Challenge by CallistoFX. This video series is going to be aimed at solving the singular problem of all traders. Should I long or short the market? Getting your direction right is the most important skill set for anyone thinking about making trading a viable income source, because you won't have to keep second guessing yourself. You have an extreme level of confidence in your trades, and most importantly, the ability to hold through drawdown. Like what I said in the intro, I believe that successful trading can only come from proper habits and nurturing the right skill sets. My purpose for this video is to give you the correct habits, understandings, and little details that separate the top 1% of traders with the other 99% of losers in the market. Now, if you don't know who I am, my name is Nick, and I'm a multi-7-figure trader with a historical win rate of 80%, all of which is recorded live on my YouTube live stream. The one singular thing that has brought me, Leonard, Thomas, and the other traders in our team great success was the ability to form extremely consistent emotional patterns in drawdown, limiting emotional triggers to prevent rash actions and hyper-tactical action steps that has kept me and the team in check no matter how bad the trading situation was. Most importantly, for you, I'm going to be bringing you through your trading journey and the different levels that you have to go through if you want to end up with $100,000 a month by the end of this. So pay close attention. What is the Dunning-Kruger effect? It is the cognitive bias in which people with limited competence in a particular domain overestimate their abilities. In the case of trading, it is how newer traders overestimate their abilities to read and make money in the market, causing people to give up easily, lose a ton of money, and never gain success in the long run. There are 4 main stages every new trader has to go through before they finally reach the peak of profitability. These are the exact 4 stages that I had to go through. So my hope is that you skip as many steps as possible just to get to being rich without feeling the pain of losing money. Now, when you first started trading, you probably remember the feeling of your very first trade you executed on your phone or computer. The feeling of, man, trading is so simple. Press a button and you make money. You start to think, maybe I'm talented. Maybe I'm the next Warren Buffett, because you made your first few winning trades in a row. And at this point, your confidence is at an all-time high, even though you don't know anything about real trading. This is the first stage of the Dunning-Kruger effect. The second stage is where your beginner's luck run out and you start to see a couple of losses. It is your first time experiencing losses and you don't know how to deal with it. You spiral and you spiral, and after taking losses after losses, you end up losing money. This is when you start to lose confidence and try to find out what's wrong. It's tougher than you thought it was. You start to realize what you knew at the start in terms of knowledge and experience is so negligible to the vast amount of things to master in trading. I remember when I lost my first $10,000 doing prop firm challenges when I was younger. It felt like the world was crashing down on me and my confidence was at its lowest point ever. This is where most people tend to give up. And if you ever reach here, I just want you to remember that I've lost money too. I didn't give up, and here is where I am. There's also hundreds, if not thousands, of testimonials of success stories groups of people that have busted their very first account, lost $50,000 in a day, but they all came back stronger through the sheer hard work and knowledge farming. The third stage happens as you dig deeper into the concepts and strategies. You start to become impatient and frustrated. You're getting some wins here and there, but not consistent. It becomes a struggle to keep up the motivation to keep learning and backtesting and live trading without seeing much results. This is where confidence hits an all-time low, where most people tend to quit. For those that persist, showing up daily to the charts, backtesting, journaling, and most importantly, reviewing everything that you do, only then will you start to see results. You start to see more consistency, and you become more competent in the markets. You start to see more wins than losses, and your profitability picks up as well. And of course, your confidence ultimately picks up. This time, you're more knowledgeable than you were at the start, and your confidence is backed by the knowledge and experience you've gained over time. Most people need to understand that trading is not a get-rich-quick scheme. It is a get-rich-slow scheme. It takes time, patience, and dedication to see the result. Think about it. If a doctor goes through 7 years of university education and attending to patients, shadowing a more experienced doctor before seeing a decent salary, what makes you think trading is going to be any easier? Not saying that it will take 7 years, but the main point here is that you need to give yourself time to get good at it. It took 1.5 years for me to become profitable with no help whatsoever. But with our help, me, Lennox, Thomas, and the rest of the team, it can definitely be quicker as long as you put in the effort on your end. Alright, I'm cutting the fluff. Let me bring you through some ultra tactical steps to follow through this trading journey with me. Use a realistic lot size even though you're in practice. Use 3 to 5% per trade. This way, you build a good habit of risk management properly, even if you're on a demo account or even on your live account. If you don't know how to calculate lot sizing and risk per trade, go to Callisto Summaries. It should be sent on the day 2 of your onboarding with us. There's a calculator there to give you the exact lot size, trading pair, and stop losses you need in order to keep a realistic trading plan. Now, you don't want to harbor bad habits in your early stages of your trading journey, as it will be extremely hard to unlearn and relearn those bad habits. Second, you always have a planned stop loss. If you have a stop loss put on your trade, respect it. You have it there for a reason. If you get stopped out, you are wrong, and that's fine. Accept it, review it, and move on. Do not, I repeat, do not ever remove your stop loss just because you want your trade to play out. Third, ensure that you are honest to yourself. I know it sounds really stupid, but I've worked with thousands of people, and a good percentage are extremely delusional when it comes to their own results and their trading. In trading, you are responsible for your own actions. You are lying to no one else but yourself. If the trade isn't going the way you like it to because of the lack of volume, or perhaps maybe this price is currently outside the kill zone, news is incoming, and a host of other reasons we'll explore in this challenge, you have 2 options. Number 1, if you're in profit, close partials and set SL to BE. This allows you to go risk-free on your trade and ensures you put money in your bank account for all the hard work that you put into charting this trade. Number 2, if you're in drawdown, close or take partials in loss to minimize the overall loss taken, allowing you to reduce your risk exposure. Number 2, if you're in drawdown, close full or take partials in loss to minimize your overall risk taken, allowing you to reduce your risk exposure, giving you more room for you to take advantage of a higher probability trade. Most beginners have this do or die mindset where they think that this trade is the last trade they'll ever take. The pros think about it as capital preservation, not do or die. Lastly, do not ever FOMO into a trade. fear of missing out. I know this is a major issue with many new traders. You see a move go so goddamn fast in your direction, but you didn't enter. And the urge to just press the button to get in on a trade to make some profits is so tempting. Do not do it. You have no proper risk management for a trade. You don't know how to manage the trade in drawdown. You are just giving money away to the markets for absolutely nothing in return if the trade doesn't go your way. It is absolutely not worth it. Okay, so this is probably the most important habit that you have to build if you want to have long-term success in trading. Reviewing your trades. It is important to celebrate every win and strive to improve on every single loss that you get. Celebrating wins isn't about getting a Rolex, buying a car, going for a $500 meal with your buddies. Celebrating wins is about understanding the conditions that have come together to cause a win like this. Were you emotionally sound? What kind of trading strategy did you use? What kind of risk management strategy and profit-taking process? What were the confirmations and the timeframes that you use for charting? If you take a loss, make sure to review your trade to ensure that you understand the reason for that loss. Was it because you didn't follow your trading plan or because you were emotional? Jotting down in the journal is crucial so you have a visual evidence that these are the mistakes you have made and you look to avoid these mistakes in the next trade that you take. Doing these things make you feel like the effort that you put in is worth it. This was my personal, never-ending supply of motivation to prove to me that I was making progress in trading. Now, the competency you build over time after being able to review your trade and understand what went right or wrong will build your confidence in trading. I want to give you a reframe. Don't just take note of the overall P&L as a trader. Take note of how you're journaling and what information you're getting from the journals month on month. This is the sign of a successful trader, learning from your mistakes and wins. Now, remember, as traders, our job is to make money in the markets, not to look for the largest trade in mankind. This means that you should focus on how much you make in trading in the long term, not how many risk to reward ratios you caught in one singular trade. No one's going to care how many RR your trade ran. They'll be more impressed with the amount of money that you've made in trading in the long run. Most importantly, the aim of a trader is to be profitable, not to be right. I can be wrong in the market and still make a profit because I have proper risk management and I don't have an ego of trying to find the perfect trade. To end off, I want to go through with you what are some of the habits of a profitable trader versus one of which I've seen turn out to be an unprofitable trader. The first difference is that a good trader ensures that throughout their journey, they are focusing on the skill sets that make them money. This can be risk management, emotional management, strategy management, concept understanding, and so on. What you don't want to do is to focus on the money. Focusing on the money when starting out will only cause you to become greedy, emotional, and impulsive when making a decision about your trade. The next thing a good trader does is actively journal and backtest their trading strategy. This way, they know how to fine-tune their weak spots in trading so that they constantly evolve as a trader, and at the same time, they can increase their win rate when they take trades. What you shouldn't do is rely on people to give you information. Lazy to do your journals. Let me give you an example. Someone that copies their homework in school versus someone that provides the answers to the person that is copying the homework. Who is more likely to perform well in the exam? Obviously, the one who put in the effort to do his own studying instead of relying on people to tell them what. The next point here is extremely important. Showing up daily to the charts to get your experience up. Let me give you an example. Person A starts trading 1 month ago, but he shows up every single day on the live stream looking at the charts himself. Versus person B, who only shows up 2 to 3 times a week when he feels like it. Who will end up more fluent with their trading skills? Obviously, person A. I can't stress this enough. Your brain requires the repetition of seeing the patterns on the chart to be able to understand at an accelerated rate. The more reps you get in, the better of a trader you will be. So don't be lazy once again. Also, please take ownership of your own action. Your success depends solely on your action and accountability to yourself. Every single trade that you take, be it my signal or your own, you have a choice. You can choose to trade for yourself. You can choose and decide for yourself whether if this trade that you're about to take meets your criteria. Do not, and I repeat, do not blame others for your own failure. If you take a loss, own it. Immediately think of ways of how it can be rectified and never repeat it again. Lastly,
A good trader is patient and logical with their results. Every single thing that they do, whether they decide to take a trade or not to take a trade, has a logical reason. Remember, before you take action on anything or anything in trading, be it taking a trade, closing a trade, FOMOing into a trade, setting SL to break even, ask yourself, what is a logical reason for doing something? This way, you can be self-accountable. And if you were to seek guidance from the team, it is easy to help you out if you have any issues in the trade. Okay, I promise this is the last thing, but the last thing you want to be is to be impatient and impulsive with trading. If you are impatient and impulsive, you are only setting yourself back further and further away from your trading goals. I hope this video helped you in understanding how a profitable trader thinks and how you can frame yourself for success with just your mindset and attitude towards trading.
Welcome to the second video of the Directional Accuracy Challenge. Before going through the concepts in depth in my further videos, I want to give you a simple yet profitable strategy to be able to make money in the markets in no time. Make sure to take out your notebooks and let's get started.
Alright, so let's get started with the quick win strategy. Now this strategy is a 15-minute scalping strategy, or I would call it scalping strategy, and it requires 5 steps to execute, and it has yielded myself and of course other premium members that have been inside premium for a while quite high win rate, extremely high win rate. And I want you guys here to take out your notes right now and start jotting down notes on this strategy. Okay, so let's get started. Now, what is a breaker block? This strategy here requires the use of a breaker block, okay? And a breaker block, I understand you may have heard it before on my streams or perhaps on some other people's YouTube videos, but the idea of a breaker block, I'm going to keep it very, very simple, okay? Just think of it as a resistance that broke through like this. Price broke through the resistance and then became support, right? What do I mean by that? Price comes back into the resistance, uses the resistance that has failed as support area to look for buys. So this is normally commonly seen in your break and retest, right? Normally you see break and retest, this is what it does. And that is what a breaker block is, but in SMSLE/ICT term. When you see a breaker block, what actually happens? What happens is that there is actually a failure of an order block. So each time you identify an order block, which will be in the video that I'll be covering next, right? Order blocks. When you see a failure of an order block, what actually happens? You actually break through a key level and it acts as a support or resistance. Think about it that way. So let's say price action, as seen over here, there is going to be a example, right? We have a bearish order block, a buy to sell that has broken through with a body candle close. So if there is a body candle close, this bearish order block now fails and turns into a bullish breaker block. Just like how a resistance here has broken and turned into a support after testing it. So once price broken above, test, use it as support, look for buys. Exactly what a bullish breaker block is. On the flip side, you have your bearish breaker block, right? This happens when you have a bullish order block that has failed with a body candle close. And when you have a body candle close, great, your bearish breaker block comes out. So I'm gonna put it in simple terms as well, right? Let's say you have a support here, price created a body candle close below the support, right? And it now turns into resistance once price comes into it, and of course, looking for potential sells towards the downside, right? So this is exactly what it is. Just think about it as a break and retest zone, using our order blocks to identify them. Now, of course, this is the first concept that is part of this strategy, right? The quick win strategy. The next part is you are going to need indicators to help you, right? Like I mentioned, this strategy is going to be very simple for everyone and anyone who wants to start with a easy to use strategy and follow the rules exactly as it is. So the first thing here, what I need you to do is go ahead and add these 2 indicators into your chart. So first one is going to be the breaker blocks with signals by Lux Algo. All right, click on it, star it, favorite it, and add it into your chart. And once you've done that, the next signal you want, the next indicator that you want to add in is going to be the moving average simple, right? Or SME, right? Simple moving average. So once you add both of this, very, very good. There is one more step. What you want to do here is change the SMA indicator setting to 44. Now, the original here, right, is going to be 9. The standard one is 9. Change the number to 44. Why 44? Very, very simple. You want to be able to understand that I have actually backtested this, and the number 44 is going to be the best or the sweet spot for this strategy to work. It's yielded the highest win rate. I've tried with 50, 80, or even lower, like 1, 2, 3. Of course, those don't make sense, right? And of course, 44 here was the sweet spot that I've done on my back testing, which I'll show you the results later on, right? And to show you why this setting number 44 is very, very good for us for the strategy. Here's the first criteria for the logs. Very, very simple. Okay, you just need to take this down very, very carefully. I'm going to be explaining both the buys and the sells scenario. So if you're looking for buys, okay, step 1, what you want to do is look for a break of the most recent lower high. Now, price action here has done what? Has created a high, then created a low. And this low here has broken past this low, creating a lower low. Because this was the previous low, right? And it broke past it, broke. Cool. So if price action wants to continue higher and I'm looking for buys, I need to look for a break of a lower high. So that means I need to see this area here break. So what does price do? Very good. Price breaks. So once it is broken, step 2, make sure that the current candle has closed above. The current candle here has closed above the lower high. And what you want to do is make sure that you check that price is currently above the moving average. This is key. Price must be above the moving average, because the moving average now acts as a potential, like a pseudo support level, or it's like a dynamic support level for you to have confluence. So the SMA here is the confluence. All right. And as long as price is above the moving average, that is your confirmation. Okay, great. So now this is step 2. Okay, you check that price is above the moving average. Step 3, wait for the breaker block indicator to pop up. In this case here, you can see very, very clearly there is a green color box that has been highlighted the moment the body candle close, as seen from step 2, right? The moment the body candle close like this, the breaker block indicators pop up, which is very good. Okay, now step 4, what you want to do is wait for price to come back and tap into the breaker block. Okay, so what you want to do here is enter at the breaker block with stop loss at structural lows like here, or all the way down at the swing low, or you want to put it at the breaker block itself, also can. I personally like to put my stop losses at the structural lows, like give it like here, for example, gives it more room to breathe, right? So of course this is exactly one of the example of how it plays out. So let me go through exactly the thought process and how to identify this winning trade here. Even though, yes, this trade had a bit of drawdown, let's explain it to you right now. So, pay close attention, yeah? Price action first created a move down, right? And if I'm looking for buys, I need to see a break of the most recent high. And price did break past the most recent high as seen over here. Price has broken it. Now, once price action actually broke it with a body candle close, which is the second step, I want to see a body candle close, and we need to check that there's a body candle close. Bam, like this. Body candle close. Now, what you need to do here is look and check for the moving average. Okay, good. Is the moving average above or below price? In this case here, the moving average is below, which is what we want. We want to see the candle or the current price action above the moving average, telling us that the moving average is being used as a support. And as you can see, the moment price retests the breaker block is where I entered a buy position. Where did I put my stop loss? Structural low over here. I can put it here at the breaker block, but of course, to me, like I mentioned, I like to put my stop losses at structural points instead of just a random breaker block. So at this structural low was a safe place to put my stop loss, because there is a sell to buy, creating this massive push towards the upside. So this was the origin, and therefore I need to place my stop loss below this level. And of course, for the target, what did I do? I target a very strict 1:2 RR. This is a 1:2 RR risk. All right, so this is how this trade played out. Of course, as you can see, price came down to drawdown. You guys might be worried. Not to worry at all. Okay, but this is exactly how the trade played out here. Now, if you take a look at another example here, you can see very, very clean example, right? Over here, you can see price action was going towards the upside, right? It was going towards the upside, but in the meantime, created a break below this low, below this low, below this low, creating lower highs, lower lows, lower highs, lower lows. And then price broke above with a body candle close. This candle over here. Okay? This candle over here created the body candle close. And because it created the body candle close over here, this indicator pops up. Right? So what you want to do here is check. Is price above the moving average? If the answer is yes, good. All I need to do now is wait for a retest. And as it retests, ideally, you want to see price action still be above the moving average, just like how it is here. This is when I execute a trade. I take a buy, stop loss below the low, structural low, as per usual, right? And target a 1:2 risk to reward ratio. Bam! Full TP smash. Very, very simple trade. Stop loss size is roughly around, 20 or a little less than 20 pips here, and a target of a 1:2 RR, which is about 30 plus 40 pips. Right? Very, very easy strategy to execute. You just need the indicator as well as the moving average. Alright, so make sure to implement them correctly. Now, I want to go through one buy example before I go into the sell example. Okay, now, same thing. If I'm looking for buys, I'm going to see a break of a lower high. So, price action here has created a lower high, created a lower low, lower high, lower low. Price broke above everything, right? But this area here did not create a body candle close. So, is it valid? Answer is no. This breaker block indicator will not pop up if it closes as a wick like this. It will not pop up if it closes as a wick like this. If price action so decides to create a body candle close after, which it did right over here, this specific bullish candle that started to create a body candle close over here, this is exactly where the breaker block indicator will start to flash. So you want to be careful. The indicator will do the job for you. It will highlight the breaker block for you, and once it shows, you want to check, is price currently above or below the moving average? In this case here, price is above the moving average. And therefore, this is confluence that we can look for buys. So the moment price action retests, I enter a buy. Stop loss where? Below the structural low, right? The sell to buy, creating higher highs. And therefore, the stop loss should be at the structural low here, the swing low, the higher low for that matter. Because if price decides to break below, I don't want to be in the trade. I will be wrong. But if price wants to continue higher, then of course, it should respect this low, and therefore the stop loss is placed here. And then of course, a 1:2 risk to reward ratio, full TP smash. Now, of course, for the sell setup, it's going to be the opposite. What you want to see is for number one, a break of a higher low. Take this down, yeah? A break of a higher low, number one. Number two, once you do that, you want to ensure, you need to check price is below the moving average on the 15-minute time frame. Now, this strategy is 15-minute time frame exclusive. You're not looking to do multi-time frame analysis on this pair or on this strategy for itself. It's only going to be exclusive on the 15 minutes, like I mentioned, right? It works best on the 15 minutes. It's what I've tested, what I've tried, and I've gotten amazing results with it. So stick to the 15-minute time frame. Alright, so after you ensure that price is below the moving average, you want to wait for the breaker block indicator to pop up, be it a green color or red color. Green represents bullish breaker block, red represents bearish breaker block. And you're looking to buy from the bullish breaker block, you're looking to sell from the bearish breaker block. Okay, now once price taps back into that breaker block, or the moment it touches it with a wick, you take a position with stop loss above or below the structural highs and lows. But in this case here, it's going to be above because we're looking for sells. So if you enter here, your stop loss should be above the structural highs or the breaker block minimally. Okay, it has to cover at least minimally the breaker block. If you want to be safe, put it at the structural highs, like how I do it. And of course, the risk-reward ratio, same thing, target 1:2 RR. Okay, now let's go through some examples once again. Here, 15-minute chart on CAD JPY, you can see price action has created a break of a higher low after breaking past the higher high, creating a brand new high here. Price broke past this low, resulting in a failure of a bullish order block, the sell to buy. And therefore, this indicator automatically gives you a sell breaker block, a bearish breaker block. And of course, the moment price created a body candle close, we checked, is price above or below the moving average? The answer is below. Right, as you can see here, as the candle forms and closes, the moving average is telling us that price action is still bearish. Why? Because price is currently below it. And therefore, the moving average acts as a resistance, a dynamic resistance that is moving along with price. So of course here, since price is below the moving average, I'm using this as my confluence. And what's the next step here? I'm going to be looking to take a sell at the breaker block itself. Once price comes back to the breaker block, I enter a sell with stop loss above the swing high, which is the structural high itself, and then of course looking for price to come all the way down for a 1:2 RR. As simple as that, right? It's very, very straightforward. The moment you see a indicator flash red, look for price. Make sure that it is below the moving average. Good. Then you wait for the retest. The moment it retests, you enter, and then you place your stop loss above the structural high. Target a 1:2 RR strict. And there you go. Full TP. Let's go through two more examples. Here, you can see the Euro US dollar. The Euro US dollar here, we can see price action created a high first, breaking past this high, and then we start to break below with volume. Right? Price action really started to dump all the way down. And what did price do here? Price, the moment it created a body candle close, what did price do? Price came back in a short little while. But at the time of breaking this level, the moving average is telling us that price is still bearish. Why? Because the candle closed below the moving average. And because it closed below the moving average, it's a bearish sign. Price action is telling us that the resistance is, or the dynamic resistance of the moving average is still being respected. So of course, as price come back and tap into the breaker block, this is where I entered a sell. I entered a sell here. We stop loss above the structural high, targeting a 1:2, and bam, we tap a 1:2 just like that. Right? So same old, same old. You're following these 5 simple steps. You're looking for a break of a lower high or a higher low. Okay, so in this case here, what has price done? Created a higher high, and then it break past the most recent higher low. Therefore, the indicator here shows us a bearish breaker block, since we have a body candle close right over here. So what did price do? The next candle, I waited for a retest. Bam! Now the question is, was I missing a step? Think carefully. You need to always remember to check that price is currently below the moving average if you're looking for sells. So that is the step that you should do. Okay, so I repeat, step 1, body candle close, breaking below a structural low. In this case, since you're looking for sell, you want to see a break of a higher low. This is the higher low. Price broke through it with a body candle close. Good. Step 2, check if price is below the moving average. If it is, perfect. We are going to be looking for the next step, which is step 3, the retest. The retest of the breaker block here, right? Retest of the breaker block after it shows up on the indicator. So step 3, wait for the indicator to show up. Step 4, enter on the retest with stop loss above structural highs. So in this case here, price came up, came down, came up, then broke through. So this is where there is a structural high. So I placed my stop loss above, target a 1:2 risk to reward ratio. And what did price do? Of course, price rejected off the area, came down, chopped a little bit, almost came back to stop loss and break even, and then boom, 1:2 achieved. This trading plan is very, very simple. Let me just go back here to make sure that you understand. Okay, for sells, you want to be looking for a break of a higher low, because in an uptrend, you have higher highs and higher lows. And of course, if you're looking for a potential reversal, which is what the break and retest is for breaker blocks, you want to see a break of a higher low, ideally with a body candle close. That way, you can have your breaker block form like this. Your indicator will flash for you. All right. And of course, make sure that price action is below the moving average when you're looking for sells on the 15-minute time frame. Okay. Wait for the indicator to pop up. Okay, once the indicator pops up, good. I'll be looking for the retest, and I'm selling at the retest itself. Doesn't matter if it's a wick or a body candle close. The moment it touches the breaker block, I'm taking a sell with stop loss above the structural high, targeting a 1:2 risk to reward ratio. All right. So now there is a specific trading window for this strategy. Which time should I be trading this strategy from? Right. Okay. Listen carefully. Number one, you do not want to trade during rate follow news. So things like NFP, CPI, FOMC, avoid. If the session itself has no news or is newsless, basically there's no news at all, then sure, this strategy works very, very well. Okay, it works best without insane volatility. Okay, the next thing here is that you want to trade between 12 p.m. GMT plus 8 in the afternoon all the way towards 11 p.m. GMT plus 8. So basically you have a thereabouts 11-hour trading window for you to look for opportunities. And this window coincides with the London and the New York session, right? Asian session, we are avoiding it because, of course, Asian session, I've tested it, I've gotten the results. The results aren't very good. Win rate is not very high. And therefore, I've just restricted the trading window for myself from 12 p.m. to 11 p.m. These are the timings that you can look for a trade. Right, so these are the two things that you need to take note in terms of when you should be looking for a trade. Okay, now, the next part, I want to talk about risk management. Okay, now I mentioned to target a 1:2 risk to reward ratio strictly, right? Now, understand the way that we have trading, or the way that I trade myself. I always set my partials SL to break even. But of course, I'm catered to those of you guys here that also prefer to hold a trade, full TP or full SL. So the first one is going to be the risky method. Okay, you want to let the trade run its full course. Doesn't matter if it's drawdown or whatever. If it hits SL, it hits SL. So be it. If it hits TP, it hits TP. So be it. You do not interfere with the trade. Let the trade run. The safe method here is that at 10 pips profit, you set your SL to break even, and you take 50% partials, you let the rest run to full TP. This is what you want to do to ensure that you secure as much as possible. Remember, the average stop loss size for this is anywhere from 10 to 20 pips. You don't normally see a stop loss larger than 20 pips. If you see a stop loss larger than 20 pips, then of course, then you are looking more at a swing trade. But this strategy is more of a 15-minute scalping strategy that will help you win quite easily as long as you follow the safe risk management. Now, of course, I have backtested results to prove exactly why I say I prefer the safer method. Okay, so I backtested all these pairs here over the year of 2023. Okay, these are all backtested results. We actually done a video on this already on YouTube. And of course, we talked about the results. And this is exactly why you want to focus on setting your SL to break even and making sure that you are trading within that time zone. As you can see here, right, I've backtested the majors as well as the yen pairs. I personally prefer the yen pairs, and that's why I like to use them, or that's why I like to trade GJ, EJ, and stuff like CHF, GPY, because of the fact that the strategy, or this current strategy, this quick win strategy, has yielded me more results in terms of the majors. But I know a lot of you guys here love majors because you know what, the spread is very small, right, and you get smaller movements and you can risk more. Personally, Euro US dollar, GBP US dollar, AUD US dollar, these are the three pairs that you can use to trade this. You can use the strategy to trade it, and it will give you a decent result of 65% win rate. Now, you must understand, even at a level where you are actually shifting your SL to break even, the whole point is to put money in your pocket, like I mentioned in the first video. So that's why we have a higher win rate. Some of these trades here don't hit full TP. And that's the reality, because you shift your SL to break even. Sometimes price comes back to break even and then goes to full TP. And that's fine. But the key point here is to make sure that you are taking your partials to ensure that you put money into your pocket, you put money into your MP4. You're realizing the gains. That's the most important. Alright? So if you so choose to take, or to basically give zero fucks about risk management, sure. SLTP, so be it. Look at the stats. You do the math. For a 1:2, minimum percentage to be profitable or break even minimally is going to be 1:33, right? Or like you need at least a 33% win rate. Okay, a 33% win rate for you to be profitable. As you can see the stats here, for majority of these pairs, you have that 35. GU is the only one out of all the pairs that I backtested that's not profitable if you only rely on full TP or full SL or 1:2 RR. You let the trade run. GU is the only one that's not profitable in terms of a win rate. Okay, but if you take a look, if you start to take your partials SL to BE, it instantly becomes profitable. So the trading plan is already profitable on its own. But you need to understand how you can risk manage to make yourself even more profitable. And this is exactly why we take partials and set SL to break even at 10 pips. So of course, use this data as much as you can. If you want, you can go and backtest it yourself as well. And of course, make sure that you're comfortable with the strategy before executing it live. That's the most important.
This directional accuracy challenge video, we'll be talking about market structure. It's one of the key foundational concepts for smart money concept, which requires you to understand where the market is going. If you don't master this, you will not be able to tell or take high probability trades from the beginning. So make sure to take down notes and let's get started with the video.
Alright, so as mentioned in the intro, you need to understand how the market moves and the trends that they are making. And in SMC, we call this term market structure. So market structure refers to the identification of trend in the markets, and there are mainly three different types: the bullish, bearish, and the ranging. Now, I'll be explaining each individual one very, very carefully. So going through the characteristics of a bullish market structure. First things first is that you want to see that price action as it's going up towards the upside, there is going to be very, very aggressive move upwards. Now, let me give you an example. Price action came down and then pushed up very aggressively. And in comparison, as price is coming down, you want to see price slow down as it's coming down, taking longer than how it did to come up. Therefore, this creates a retracement instead of a potential reversal. So very, very important that you need to see that there's a price slowing down as it's coming down in an uptrend. Remember, this is a bullish market structure, so you should be expecting price to move towards the upside. All right, price action should slowly go towards the upside here. One key thing that I like to see on the stream is that for the market to continue bullish, we need to see a creation of high highs and higher lows. Now, in this chart example here, we can see price has created a low, a high, a higher low, plus a higher high. So each time price is trying to break past the previous high. And when this happens, this is called a break of structure. So for simplicity's sake, whenever I see break of structure on stream, or whenever you mark out a break of structure, understand that a break of structure is going to be a continuation of a trend. All right, so let's hop onto the bearish market structure. Over here, you can see, same thing, it's just the opposite. You want to see that number one, price is generally moving lower, right? Because you're bearish for the market. You want to see price go down. The characteristics here switches. You want to see that the downside movement, or as price is coming down, you want to see it come down aggressively. And of course, as price is retracing, like this, 1, 2, 3, these three candles, you want to see it slowly come back up instead of a very aggressive push towards the upside, right? To indicate that this is a retracement instead of a potential reversal. And most importantly, you want to see a creation of a lower high, lower low formation. Now let me bring you through this step by step. You can see price created a high, created a brand new low. Price then created a lower high before creating a lower low. And this continues and continues and continues all the way until price decides to completely reverse. Okay, so for bullish, you want to see higher highs, higher lows. For bearish, you want to see lower highs, lower lows. So these are the first two types of market structure. Now the next type is the ranging market structure, right? You may be asking, oh, how do you identify a range? Very simple. You must see at one look, the moment you look at the chart, you can see price is failing to create high highs or price is failing to create lower lows. There is no clear direction. We are basically in a small little rectangle. Price is not doing anything. There's no clear direction. Okay, and when this happens, most of the times it's stuck between two key levels. Number one, support area. Number two, resistance area. And as you can see, as I've marked out, a support, for those of you guys here that don't understand what a support is, I've covered this in my earlier video. A support is going to be where there is price action rejecting multiple different times, failing to break below. Whereas a resistance is a key area in price where price action has been holding quite well and failing to break above a key zone multiple different times. So personally, my trading style, I like to stay out of this, or I wait for a breakout of either the resistance or the support to take a potential position. All right. So now, how do you tell when the market is about to reverse? Okay. So first things first, you need to understand when the trend breaks from its intended direction. So that means, number one, you need to understand whether the market is in a bullish or a bearish market. In a bullish market, you want to see a break of a higher low as marked out in this structure over here. As you can see, price is creating high highs, high lows, high highs, high lows, high highs, high lows, and higher highs once again. And then price continues to break through, reverses, breaking past the most recent higher low right over here. And once price does that, what does price actually form? A lower low. And when you see lower low, you're expecting lower highs to form and then another lower low to form, because that's how a bearish market structure look like. Once you see the most recent high low here breaks, this is what we call a change of character, or what we call it as shock chi, right? So change of character is a reversal pattern. That's basically it. To simplify it down to the very, very basics, you want to be able to understand and identify a change of character by seeing a break of a high low in an uptrend. Now, what if you are in a downtrend and you see price move up? How do you identify it? Same thing. Price is coming down, creating lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. And then suddenly price starts to break past the most recent lower high. And when you have that, this is what we call a change of character. So as long as you break past the most recent lower high, there is intentions of the market potentially reversing towards the upside. Extremely, extremely important. So let me give you an example of the bearish change of character. As you can see here, price created higher high, higher low, higher high, higher low before breaking past this high here very, very slightly. But still, a break is a break. And therefore, this is a higher high. Each time we break past the previous high in an uptrend, we call it a BOS, just like I have marked up. Price came up all the way, came down, retraced for a little bit, and then continued pushing higher, creating a BOS. But right after the break of structure here, BOS, price created a break below the most recent high low. This creates a bearish change of character. And with a bearish change of character, or a shock chi, it indicates a potential bearish reversal. And what does price do right after that? It comes back up, tries to break past this high, but fails. It respects it. It creates a lower high. Therefore, completing that lower low, lower high, lower low formation, creating a bearish market structure. So this is how you identify a change of character in terms of charting. Now, same here for the bullish change of character, right? What you want to see is price action come bearish first. As price is coming down, creating lower high, lower low, lower high, lower low. Once price breaks above the change of character level like this, breaking past this level, then you have a creation of a higher low. And the expectation is for a higher high to form, which has already been done. Price pushed up towards the upside. What you want to see is for price to come down and create a higher low to continue that uptrend move, creating of high high and higher low. Now, in this specific case here, you can see price comes down into this key area before pushing up once again. And price creates a higher high here, creates a higher low here, and the cycle continues towards the upside. I want you guys here to pay close attention, right? Market structure may be simple for some of you guys here, but if anything, this is the slide to pay the most attention to. I get these questions every single time on stream, and I want to clarify it here right now. Structure mapping. How do you mark out your swing highs, your swing lows? How do I mark out my break of structure? Do I mark it with a body? Do I mark it with a wick? Listen very carefully. I always use wicks. Why? It tells us what happens with, or it tells us what happens during the candle itself, where the highest price has been and the lowest price has been. And that's the most important. If you don't account for wicks, you are leaving out important information that the chart has given you. And that's why I use wicks to mark out my highest point in price and lowest point in price. It's a more accurate judgment of whether structure has broken. Okay, but when you're looking for your break of structure or your change of character, when there is a potential reversal, what you want to do is use body candle closers. Just as this example here, type 1. Don't use type 2. Type 2 is for very, very aggressive scalping kind of trading style, which most of you guys here are not used to. So do not use type 2, use type 1. What you want to do here is, for example, in this case here, you have created a high, price wicked above it, but it did not count as a break of structure because it didn't close as a body candle close above this area here, which shows us that there isn't enough volume to continue going higher. And what does price do right after that? It comes crashing down before starting to create a body candle close above and then the continuation of the move higher. This is why I use wicks to mark out my highs and lows, but I use body candle closers to confirm my break of structure and change of character. Right, so now let's dive into some live charts and take a look at some live examples of how to use your body candle closers and your wicks, as well as identifying whether you're in an uptrend or a downtrend on the charts. Alright, let's take a look at the GBP JPY chart on the 1 hour time frame. Now I'm going to be marking out the key levels here and the areas that I deem as a change of character. You guys can follow along and see how this actually plays out. And of course, price action will tell you exactly what it's going to do, whether price action is going bullish, bearish, or when it's going to potentially reverse. And let me explain. Now, as you can see here, price action has created a move up before coming lower. Right, so in this, if you look towards the left, you can see price has been coming down, and therefore we can assume it is a bearish structure because we have lower highs, lower lows, lower highs, lower lows, and it keeps going. The moment price starts to break above this area, we have a change of character. Now, this change of character here is considered a weak change of character because there's no body candle close. Like in my slide earlier on, I mentioned you want to see a body candle close. So now, as you can see, price created a body candle close above it, making this a valid change of character for price to continue going higher. And what does price do? Price created a structure like this, a sell to buy, creating a low and a high right here. So of course, I'm expecting price to come down, to retest, to continue even higher, to create that higher high. Because right now we have low, high, higher low, higher high. But if you take a very good look, price action immediately creates a change of character below this low here. Why? This is the most recent higher low. And once price breaks below it, and this time also with a body candle close, this is a change of character and a strong one because of the body candle close. It gives us the confirmation that price action wants to continue going bearish because it allowed price to stay below this key level. And as you can see, price retraced, it's hovered around for a little bit before creating another move lower. So your structural high for this buy to sell is going to be at this key level here. So that means your high is here, your low is now here. And as you can see, price retraced once again, respecting this high, did not break above this high and continued lower. So this is now where you have highs, lows, lower highs, lower lows, confirming a bearish trend. All right, and as you can see, if I continue following price, price continues lower and lower and lower, making it a very high probability move all the way down until such a point the 1 hour decides to give us this price action. Follow me closely, all right? Low, high, lower low, lower high, and then another lower low before creating a huge move towards the upside, breaking past structure. And this was the most recent lower high that has been formed. Okay, this most recent lower high that has been formed has created this brand new low here. But an indication that you can understand when price is starting to potentially reverse is when you start to see that in a trending market, and in this case here, a bearish trending market, the move towards the downside is slowing down. That is exactly when you can tell that the sellers are slowing down, buyers are stepping in. And to confirm that, you see a change of character right here with a body candle close, of course. And what does price do? Ultimately, it plays around for a little bit, before coming into the change of character and then rallying further once again, creating a higher high. So this is how you identify market structure. Alright, so let's take a look at one more example on gold. Alright, so on the 4-hour chart here on gold, you can see that price action on the left has created a very nice bullish up move. But of course, let's mark it out together. Alright, so where did price action actually start to go higher? You can see price came down, came up, breaking past the previous structural high here with a body candle close. Right, this was where the body candle close happened. So of course, where was the lowest price, the lowest point in price went before going higher? This key level right here. And let me ask you a question. Right, just think to yourself, did this low right here break below? The answer is obviously no. Right, it came very close to it, but it didn't. And this is our higher low. And therefore, the bullish move towards the upside is still being respected, and therefore you start to see a change of character here. One key thing about this change of character is that price action has created a buy to sell within this area here, which is what we call internal change of character. The difference between internal and external change of character, let me give you an example here, right? Price action has created a swing low and a swing high. And at this point, price action has created a retracement, and in this case, a very heavy retracement. And you can see, if I were to draw how price action has actually formed, price has created a high, a low, a high, and then another low before starting to create the change of character, but breaking past this high right here with a body candle close. So this internal change of character, which is a bullish change of character, respected the swing low and continued to break past the external BOS level. Why is this a BOS? Because we are in an uptrend, and in an uptrend, each time you break past the recent high, there is going to be a continuation of a trend. And like I mentioned, a BOS or a break of structure is used in correlation with a continuation of a trend. All right, so following price continues higher, retests the BOS level and continue higher again, breaking past this high, giving us another BOS. Okay, BOS right here. Price continues all the way up. So at this point, as price continues all the way up, we start to see price slow down around this area. All right. So at this point, we initially just had one very bullish leg all the way up to here, and then we start to retrace, and then we broke past this high once again. Let me zoom in so that you guys here can see it very clearly. Let me remove this line. You can see price action has broken past this high, resulting in a break of structure towards the upside. Why? Because overall price action was still bullish prior to this move lower, right? Price action was still extremely bullish, many different bullish candles here. And of course, what happens right after that? Price creates what? A break past the most recent higher low. This results in a change of character, a bearish change of character. And what gives this even more confirmation that price action might be able to reverse is that there was a body candle close below the higher low, creating a lower low that's very strong. So of course, price retraced, fails to break past this high, resulting in a respect of this high. And therefore, this creates a lower high right here. Okay, so let me just mark this out. Low high. And then we have a higher high here. Just put this as high so that you understand. We have a high, price broke below, creates a lower high. At this point, this is where we had the lower low from the past. Price broke past it again with a body candle close. Right, BOS, creating another lower low all the way down to this area here. Then we start to have a small minor retracement. But how could we tell that we are going to be in that retracement leg, or perhaps maybe respect this high and continue lower? Just draw it out. Do exactly what I'm doing. Price came up, came down, breaking past this low. Price finally created a change of character right here. Initially first as a wick, which again is a weak change of character. And what you want to see here is a body candle close above to confirm that we can look for potential upside. And this is especially useful if you're going to be trading on the lower time frame to help you tell the direction of the trades that you want to be taking. All right, and of course, price ultimately retraced and then continued lower once again. So as you can see, I went through price action from all the way down here, following price, and then we had a switch in market direction from bullish to bearish to bullish and then bearish again. And this is exactly how the market works in cycles. It goes up, it comes down. All right, and how you identify when it's going to reverse is by using a change of character. So I hope this video here has given you a lot of insight as to how I mark my market structure and the intricacies that you need to understand when marking your market structure in order to give you confidence for your lower time frame entries.
Welcome back to the next video of the Directional Accuracy Challenge. This video will be talking about one of the core concepts in SMC called order blocks. So let's dive deep into it. I'll be talking about what an order block is, how to use it, and of course, how do you implement it in a strategy. So make sure to take down notes and review this as many times as you can so that you understand this concept. Let's get started.
Alright, let's get started with order blocks. Okay, this is one of the most important concepts that you will need to know if you're looking to trade SMC the way I do. Alright, so pay close attention, pull out your notebooks, and let's start this off. Okay, so what is an order block? An order block is where the big banks and institutions are looking to buy or sell. Now, because they are banks and institutions, right, they obviously don't want to lose money because it'll look bad on their, their P&L statement and so on and so forth. But I think it's just most logical that they want to buy cheap and sell expensive. And let me explain that in a short while. Now, when you take a look at a order block, right, you are going to be seeing price come down before going up or price come up before coming lower. What does this actually mean? Okay, so let me give you an example here. Let's say you're a bank, you're bank A, and you have, let's say, $10 billion worth of assets to trade with. And assuming that that amount can definitely move the markets, what I'm going to say here is very interesting. So pay close attention. At this level here, let's say price of gold is $2,000. Okay, what you want to do as a bank, or what the banks would most probably do, is they will cause a small little sell-off on gold so that they can get in at a cheaper price. So let's say they put in small sell positions into the market to create, right, the fear of, gold's going down, I'm going to sell. And that's when people look to sell gold, right? And price comes down, let's say price comes down all the way to, let's say, the 1995 level. And this is where the banks or Bank A decides that, okay, cool, this is a very, very cheap level to buy from. Okay, let me load up a lot of my buy positions because that's my initial intention to look to buy the market. So after manipulating the market towards the downside, they open a buy position while leaving their sell positions open from here during the manipulation leg. And of course, when they look buys, price pumps all the way towards the upside. And why does it do this? Why does it pump so aggressively? Because the buys are way larger than their sells. Therefore, they are in overall net profit, and the losses from the sells are so negligible because it's just a small position. That's why you have an impulse move towards the upside. And same thing for the bear scenario here. If you're looking to sell as a bank, then obviously what you want to do here is get in at a higher price. And how do you engineer price to go higher? You create orders, or you put in orders, buy orders to push the market higher. So let's say they open a small little buy position with their $10 billion, right? And of course, once price comes into an area that is considered a premium area or an expensive area, they can look to put in or take a massive sell order to push the price lower, manipulating price once again, right? Pushing price down to put them into profits. So this is exactly what an order block is, the manipulation phase of it. So price comes down before going higher, you can mark out the order block like this, or price comes up before coming down, mark out your order block like this. Let me give you a clearer example on the chart. Now, you take a look at a bullish example of a order block. Okay, what you want to see is you want to see the last candle that created the lowest point in price. In this case, this area here. Price created the lowest point in price before pushing higher, breaking past previous structure. breaking past the previous highs, right? And this is how you can identify the order block, by marking out the last candle that created the lowest point in price. It doesn't have to be a red candle, doesn't have to be a green candle, doesn't matter what color the candle is, right? I can change it to purple, orange, whatever color candle, doesn't matter to me, right? As long as the candle creates the lowest point in price before pushing higher, right? I'm marking out that last candle that created that lowest point in price. And that will be my order block. So as you can see here, I mark out the order block. And now, order blocks here, and in this case here, the bullish order block is going to be a very good place for you to look to buy from, right? Just think of it as a support level, an area where people are going to be looking to buy, right? Same thing for the bearish scenario. You want to be looking for the last candle, the very last candle that created the highest point in price before moving lower, breaking past previous lows. Okay, and of course, you're expecting price to come back into it, to test it as a resistance, to look for potential sells, right? It's important to cover the wicks, because the wicks tell you where price has been, right? I don't want to be drawing my order blocks from the body itself, because there's going to be a high chance, right? Price could potentially wick past the body and test the wicks before coming lower. That has happened many different times, and that's why I have decided to place my order blocks, or draw my order blocks from wick to wick instead of body to body. All right. So, like I mentioned, bearish order blocks are very good areas to sell from as potential resistance areas. So, of course, now, with that being said, order blocks are so easy to identify. They are everywhere in your charts. You look at, crypto, forex, you have your stocks. They are going to be present everywhere. Order blocks are everywhere. But how do you identify a high probability order block? Very simple. Number one, you need to have liquidity sweep, which I will be explaining in a short little while. Number two, fair value gap. Number three, inducement. Number four, higher time frame alignment. Now, you take a look here. You can see criteria number one, liquidity sweep. You want to see the order block swept previous areas of highs and lows. Now, what do I mean by that? So you can see here, right, price created a low before pushing up towards the upside. And this is the key area that I'm looking for, right, for price to take out before going higher. And what did this candle do before pushing up all the way towards the upside? It took out these two lows, equal lows here. And therefore, this is where I'm going to be looking for price action to continue going bullish, right? So if you do see a liquidity sweep like this, this will make this a higher probability area for you to look for buys from, right? Because think about it, the liquidity sweep is basically, you are tricking people, you're manipulating people, you're taking out people's stop losses, and people have been stopped out, and price goes in the opposite direction, just like how price went up here. And of course, right, this makes this a very good area to look for potential buys from. Okay, so as you can see here, I've written on the slide that the market has created and taken out stop loss, right, collecting orders before moving aggressively in the opposite direction, making it a good area for price to trade from. So the second criteria here is going to be fair value gap. Now, like I mentioned many times on stream, fair value gaps are a great indication of telling you whether price is going to move with volume or not. If there is presence of a fair value gap, perfect. I'll be looking for price to continue higher or lower, because there is going to be volume. The reason why fair value gaps are a thing that we talk about, right? I will explain in more detail in another video what a fair value gap is and so on and so forth. But the idea here is that you are going to be looking for price to create fair value gaps, because this would tell us that there are orders left behind because price moved up or down too fast. And in this example here, you can see price has created a fair value gap, which is a 3 candlestick pattern between 3 consecutive candles, right? And what you want to see here is that there is going to be a gap between the wicks of the first candle and the third candle. If there's a gap in between, you have a fair value gap. And this is another criteria, right, that tells us that there is volume, or huge volume, coming from the order block to push price even higher, as mentioned over here. All right. The next thing here is going to be inducement. Okay. Now, what is inducement? Okay. Just think about it as, let's say you are being tricked. Okay. The market is moving higher, like this, for example. Price is moving higher, comes down, and you think that, oh, look, this could be the most recent low before pushing higher, right? So this is a swing low, swing high. You know what? I'm going to take a buy here with stop loss below here. But in reality, right, this low here didn't do anything. It didn't test a key level of a support or an order block, it didn't come and collect enough orders. There's not enough volume for price to push up higher. And what does price do over here? Price instantly comes back down, tests this area before pushing higher, failing to break past this high, telling us, okay, cool, they may not have enough orders. And what does price do? Come all the way back down to where the order block was, making these lows here inducement. Okay, so these fake high and low are being created in the market to generate more liquidity for the market to drive up into higher probability order blocks. So in this case here, price drove down into a higher probability order blocks, right? Giving the market liquidity to take this area out before collecting even more buy orders to push up even further. Okay, now the last one is actually extremely important here and I need you to pay close attention. Okay, is number 4. Higher time frame intentions. Okay, you need to understand that when you're looking for an order block, bullish or bearish, if you are in a downtrend and you're looking for a bullish order block, then more than likely your order block is not going to hold because it's going to break, right? Your bullish order block is going to break because price has intentions to go lower. So here's a guiding rule for you to really understand, right? Number 1, if your high time frame is bullish, like let's say this charts here, they were on the 4-hour, and you go to your daily time frame like this, and you see that, cool, my higher time frame is bullish, I look for a bullish order block, and that's why this order block here is holding, because the higher time frame intentions on the higher time frame is bullish, so they are aligned. So you want to align them as much as possible in order for your order blocks to be higher probability. Same thing for the opposite scenario. Let's say your high time frame is bearish, like your daily is bearish, then you see your order block on the 4-hour time frame. You definitely want to look for a bearish order block to support the narrative that price action wants to continue lower. All right. So now, when does an order block fail? Okay, I talk about how order blocks are good areas to hold as support and resistance levels. But same thing, right? Order blocks can fail. They are not 100% an area that, oh, must buy here. How do you tell when an order block fails? So in this case here, we have a bearish order block. You can see you have a bearish order block with the last candle that created the highest point in price before coming lower. Cool, mark it out. So you're expecting price to continue lower, right? But no, what does price do here? Price pushes up with a body candle close. This is when the order block fails. Okay, this order block fails and therefore should not be used to look for sells anymore. Okay, personally, wicks can also be used to tell us that the order block is invalidated. So let's see, if this candle here didn't close as a body candle close, it closed as a wick and it closed right here, but there was a wick past it, past this high. To me, I would still consider it as fail because of the fact that price has already broken past this point. Okay, so to be safe, very simple, just use body candle close to identify a failure of an order block. So if the order block breaks with a body candle close, it's failed. Don't use it anymore, right? Do not use it to look for your, in this case here, your sells. Very simple. Okay? Now, let me give you another example of why I say it's a bit tricky. This is an example of gold. As you can see here, we have a 50-minute bullish order block. We have a sell to buy, pushing up towards the upside. Now, as price starts to come into the order block, I'm expecting price to reverse. And what does price do? Price wicks below the order block here, the bullish order block here. But it did not create a body candle close. So that's why I say it's a bit tricky, right? To me, this order block is invalidated already. But however, price action started to create bullish price action, creating bullish fair value gap. And that's why price action continued going higher. So this could be seen as a liquidity sweep. However, this order block has failed, but the demand is still holding because you can see price has very, very aggressively pushed towards the upside. So to be safe, if you're looking to identify a fail of an order block, you want to see price action break below with a body candle close to look for sells. Okay, so if let's say you don't see a body candle close, simple, chillax, wait first. Wait for the market to give you more information before you decide whether to take a trade or not. Okay, now, out of these 4 criteria, right, you have your let me just go back to show you guys here. Your 4 criteria: liquidity sweep, fair value gap, inducements, and higher time frame alignment. Which of these 4 is needed for it to become a high probability? I personally use 2, minimally 2. I need 2 of the criteria to be met. As long as two of them or more are met, I will categorize it as a high probability order block. But of course, the more criteria is met, the higher probability the order block will be. As simple as that. Okay, so now let's dive right into some live chart examples and of course, show you guys how to identify these order blocks in real time. Alright, for the first example here, we can see that price action here has actually taken out liquidity plus created a fair value gap, making this buy to sell. The last candle here that created the highest point in price before dumping, breaking past the structural low and low here and here, right? This example here is a very good way of marking out an order block. And as you can see, what did price do? Price reversed all the way back towards the upside here, where there is going to be a retest of the order block to continue dumping, right? So the 2 criteria here that were met, minimally 2, right? Like I mentioned, 1, sweep of liquidity, 2, fair value gap. This qualifies as a high probability order block in itself, right? We didn't have a high time frame confluence, right? Let's take a look if we actually did. On the 1 hour time frame, you can see price action here. There we go. We had higher time frame confluence as well. 4 hour time frame, all bearish here. So this is 3 out of 4 criteria met already, just based off the 50-minute time frame bearish order block over here. All right. We did not have an inducement because of the fact that price action basically came up all the way to test the area before coming lower. So there was no like fake high or whatever. Price just created a break below, came back to retest the order block and continued dumping further. For the second example here, we can see that price action has actually created a liquidity sweep first before pushing up higher. And as price pushed up higher, right, we noticed that there was actually a small fair value gap. So therefore, we have 2 criteria here met, right? And this therefore results in a higher probability order block that we are looking to take a trade from. So as you can see here, price pushes up towards the upside, price comes down. This is where you can look to take a potential buy from. And of course, price consolidates for a bit at this demand zone, this 15-minute bullish order block, before continuing going higher and higher and higher as seen over here. So this is how you identify an A+ high probability order block with minimally 2 criteria. So let's take a look at another example here. For this example, you can see that price action has created a sweep of liquidity, right, sweeping past the previous high, creating a high, and then creating a move lower with volume. Right, and of course, you can see, right, what I want to do here is mark out the candle that created the highest point in price. There we go. We have created the candle that created the highest point in price, and this is our bearish order block. Now, this bearish order block also created a bearish fair value gap as seen over here. There we go. Bearish fair value gap on the 1 hour. FVG. There we go. So, and you can see as well, right? Price action tried to break below, but failed to break, pushed up higher, created a high that people thought, okay, look, this is a potential area for us to sell from, especially since, you know, price action, it has came down quite a bit and overall we're still in a bullish market. So what did price do? Right, on the 50-minute time frame, you can see. On the 50-minute time frame, price tried to break below this level here, actually, creating a break past this level, inducing people to potentially put their stop loss here. And what does price do? Rip above and of course come into the 1 hour order block here before completely selling off. So this is exactly how you identify a high probability order block using the concept of 4 main criteria. Number 1, you're going to be using liquidity sweeps. Number 2, fair value gaps. Number 3, you want to be using inducement. Number 4, higher time frame confluence. In this case here, we had 2. Actually 2 plus 1 inducement on the 50-minute time frame. So that's 3 already. So the 4th one here wasn't aligned because of the fact that gold has been overall quite bullish right before that. And this is a reversal here. So this is a high probability reversal order block given that there is inducement, there is liquidity sweep here, and there's a bearish fair value gap to support that. So this is how you should be marking out your order blocks. So make sure to go ahead and practice how to mark out your order blocks, right, every single day until you get to the point where you can identify without even marking it out. All right, so that is the level of consistency and how well versed you are in terms of being able to spot this order block like clockwork. You want to be able to do this every single day, every single time you look at the charts.
This video of the Directional Accuracy Challenge, I'll be talking about fair value gaps. Fair value gaps is one of the most important SMC concepts that you need to use in order to tell you whether the market has volume or not. So pay close attention, I'll be teaching you how to identify them and as well how to use them as a strategy alone, a standalone strategy that you can use to make money with. So pay close attention, take down notes, and let's get right into the video.
As mentioned, in this video, we're going to be covering fair value gaps, or better known as FVGs. I'll be using the term FVGs throughout the entire video, so be comfortable with it. Just know that FVGs means fair value gaps. Now, I'll be going through how to use FVG, how to spot one, how to know if it's being respected, and more importantly, where to know whether it failed. At the end of the video, I'll also include a way that you can use FVGs to find entries to make money from the market. So pay close attention and let's get started. What are fair value gaps, or how or why do they actually form? When the market is moving very, very quickly, price moves extremely fast. This results in orders left behind because not all the orders have been filled. Now, when these orders are not filled, they leave gaps in the market. And in these gaps, they are going to be unfulfilled buy or sell limits that were left behind, making it a good area for price to come back, return to, before going in its intended direction. Now let me give you an example. So to spot fair value gaps in the market, there are actually two different types that you need to be very familiar with. First one is being the bullish fair value gap. Okay, so a bullish fair value gap is identified by three candlestick pattern. So what you want to do is find three consecutive candlesticks where the top wick of the first candle and the bottom wick of the third candle do not touch each other. As you can see here, this red color wick here, which is the red candle, right over here, the one that I'm hovering over, this top wick here is not touching the bottom wick of this bullish candle here. And because of that, this is what we call the gap in the market. And within this gap, is what I mentioned, there are going to be buy limits at this area because price moved up too fast, not allowing price to come back down and fulfill all these orders. For the bearish fair value gap, is the opposite. You want to see three consecutive candles, but you want to see the first candle's bottom wick and the third candle's top wick not be touching each other like this. As you can see here, there is a huge gap in between these three candles right here. And therefore, I draw a box, and this is labeled as our bearish fair value gap. Now, you take a look here. How do you actually use the fair value gaps in trading? Right? Now, first thing is that to simplify it for you, think of it as support and resistance areas to look for entries. Now, why do I say that? Because like I mentioned earlier on, these gaps have buy limits and sell limits in these gaps, and therefore when price comes and collects these orders, they are used to activate those buys and sells, pushing market in that certain direction. Now, one key thing to understand is that at some point in time, these gaps in the market will get filled because the market aims to be as efficient as possible. What I mean by that is that for every buyer, there needs to be a seller. Therefore, the market has liquidity to move and price will start moving. If price action, or if the market doesn't fill any of these orders, then the market is completely illiquid and we don't have a market to trade. And that's why the market aims to be as efficient as possible. So these gaps, knowing that it will be filled sometime in the future, is going to be a good area it's going to be a very, very good area for us to target in terms of a TP or for us to place our stop losses. And let me show you what I mean. Now, you can see here on the left image, you can see that there is a three candlestick pattern, 1, 2, and 3. The top wick of the first candle and the bottom wick of the third candle has created a bullish fair value gap. As you can see here, price, after creating this bullish fair value gap, price came back down to test the area, used it as a support before launching itself even higher. Same thing for the bearish scenario here, you can see we have the bearish fair value gap here. Three candlestick patterns, count 1, 2, 3, 3 consecutive candles. And the bottom wick of the first candle here, even though you can see here, there is no bottom wick, but we use the body. Why? Because this is the lowest point in price that price has visited for this specific candle. So we draw it from here all the way down to the third candle's top wick. And because there is a gap, they're not touching, we have a bearish fair value gap, and as you can see, price retreats back into this area before using this area as a resistance to continue pushing price lower. So as you guys know, support and resistances can fail as well, right? And how do they fail? When you have a body candle close going through the support or resistance, making the support or resistance invalid. Same thing for a fair value gap. When does it fail? So for example, let me give you an example here. On the image on the left, you can see that there was actually a bullish fair value gap identified by candle 1, candle 2, and candle 3. Price tapped into the fair value gap, and by right, price should be going up. But because price action on the very next candle created a huge dump towards the downside with a huge body candle close, this has rendered this bullish fair value gap invalid. You cannot use this fair value gap anymore to look for buys. This is when you don't want to. This is when you can look to just delete that rectangle off your chart. You don't want to use it anymore, right? Because you want to see price respect this area, right? And what do I actually mean by respect? Wick candle closures. Now let me give you an example of that happening right now. You can see after it created a failure of this fair value gap, the very next candle, you can see right over here on the right side, price has created a bearish fair value gap in place of that bullish fair value gap. What did price do? Price came back up, retested the fair value gap with a long wick that broke past the fair value gap. But this is still considered a respect of the fair value gap because price went up, collect orders, and push price lower. As you can see right now, this long wick was followed by two huge bearish candles that completely dumped the market even further. Right? This is how you identify whether a fair value gap is being respected or not. Okay, so let me just summarize. If you see a body candle close outside of the fair value gap, the fair value gap is now invalid. If there is a wick candle closure above or below the fair value gap, it's fine. It is still considered a respect. So to put it simply, just watch out for body candle closures. Okay, now on the point where fair value gaps will get filled at some point, I discussed this earlier. I mentioned that fair value gaps are areas where there are buy limits and sell limits, right? Because price moves too fast, some orders get left behind. But because the market aims to be as efficient as possible, it has to fill all the orders, and therefore all these orders or all these gaps in the market will get filled, and in the process creating new gaps in the market. So it's a cycle that will happen. So let me show you in this chart over here what is exactly happening. Now as you can see here, as the price is going up, price has created one fair value gap over here, candle 1, candle 2, candle 3, gap between the top wick of the first candle and the bottom wick of the third candle. Okay, price never came back to test it, continued higher, creating another bullish fair value gap. Candle 1, candle 2, candle 3. Same thing, top wick of the first candle and the bottom wick of the third candle. Eventually, after rising and rising and rising, price started to reverse. And at this first huge, humongous red candle, price tapped into the fair value gap but never created a body candle close as circled over here. And price went up. Great. Now, this fair value gap was respected, tested before, right? So you cannot expect this area here to work again because all the orders here have been collected, all the buy orders here, or the buy limit orders here have been picked up. And as you can see, price came up and continued dumping, disrespecting the bullish fair value gap. And in the process, it created a bearish fair value gap with candlestick 1, candlestick 2, candlestick 3, gap between the bottom wick of the first candle and the top wick of the third candle. And as you can see here, price actually respected this fair value gap this time. It retraced, never created a wick above the fair value gap or even a body candle close above it, and it used it as a resistance level to push price even lower. So this is exactly what I mean by fair value gaps get filled at some point. Now, this current fair value gap has been retested. Who knows? Price may start to continue to come up in the future and completely break through it as well. Because these orders here have been collected and used already to push price or to push the market lower. Alright, here's another example. Price action here created a very bearish move downwards, and in the process, creating bearish fair value gaps. And as you can see, we have candlestick 1, candlestick 2, candlestick 3. Gap in between, bearish fair value gap. Same thing here, candlestick 1, candlestick 2, candlestick 3, bearish fair value gap because the wicks are not touching at all. So what does price do? price initially pulls back into the fair value gap, creating a wick candle closure. Now, if you remember what I mentioned earlier on, a wick candle closure is still considered a respect. And price here decided to dump lower. But as you can see, this push lower didn't bring enough volume to break past the structural low or the swing low. Therefore, price, instead of going lower, it continued towards the upside, failing the secondary fair value gap over here as well. As you can see, this long wick here has taken out orders from the fair value gap number 1 and fair value gap number 2. And therefore, these two fair value gaps are now invalid with this body candle close right here. And of course, when you fail a bearish fair value gap, what happens? Price continues going higher because there is no bearish intention of the market. Alright, so now, how do you use fair value gaps to enter trades? Listen up very carefully. There are 5 key steps. Step number 1, identify a high time frame fair value gap. Could be your weekly time frame, your daily time frame, 4 hour, 1 hour. This is great for swing traders because you're going to be looking for these areas of support or resistance to take a potential trade off. Step 2, wait for price to tap into the fair value gap. Right. Very simple, don't have to do anything, just set an alert at the fair value gap. Once it comes into it, look back at the charts. Okay, so once price taps into the fair value gap, we move on to step 3. This is when you want to drop down to the lower time frame for your confirmations. Alright, I'll explain the confirmations in step 4 and 5. Step 3, this dropping down to the lower time frame, here is a few guidelines. If you're using the daily time frame to mark out your fair value gap, you want to drop down to the 1 hour time frame. If you're using the 4 hour to mark out your 4 hour fair value gap, you want to drop down to the 15-minute time frame. If you're using the 1 hour, you drop down to the 5 minutes. This is the guideline I personally use every single day when I trade. Now, step 4, okay? What you want to see on those lower time frame is that you want to wait for a change of character in the direction of the fair value gap. So that means if you are marking out a 4-hour bullish fair value gap, you want to see a 15-minute bullish change of character after testing the fair value gap with a body candle close. Now, if you watch my market structure video, you understand that body candle closes are extremely important to tell you the intentions of the market, telling you whether the market is going up or down with strong intentions, because the body candle closes tells you how much volume there is to close above or below a key level. Alright, so this is why this is step number 4. Now, the last step is where you're going to look to enter. The moment price taps the change of character or retests the change of character, be it a wick or a body candle close, you are going to look to enter a trade. Now, these are 5 important steps that you need to know, but of course, without a chart, you won't be able to understand. So let's dive into 2 very in-depth examples to show you how I go through this and how I use fair value gaps to make money in the markets. Alright, so now I'm going to go through the examples as to what I'm going to be looking for when it comes to entering using fair value gaps. Now, I've written out the steps that I mentioned in the slides over here for your reference, so pay close attention to the steps as I go through them. Alright, now, you can see the 4-hour time frame here. We've created a fair value gap with a 3 candlestick pattern. Candle 1, candle 2, candle 3. The top wick of the first candle and the bottom wick of the third candle are not touching each other, therefore creating a gap in the market. So you want to mark this out with your box and label it as a fair value gap. So all you're going to do here is move on to step 2. Wait for price to tap into the fair value gap. Okay, cool. Price taps into it. Then what? Step 3. Drop to the lower time frame. Now, the current time frame that I'm on is the 4-hour chart. So, for me to be able to look for my confirmations, I need to drop to the 15-minute time frame. So I drop to the 15-minute time frame as mentioned in the steps. So as you can see here, price action has created a break below this low. Understand that this high here is not the swing structure high, but is an intermediate structure high. This was the last pullback that price created to before breaking past this low that created the brand new high right over here at the 2.458. Alright, so that's why I'm marking out this level here. Now, for a change of character, which is in step 4 to happen, I need to see price break above this area here like that. to continue to retest, to continue even higher if I'm looking for buys. But now, if I'm going to be looking for potential sells, this is what I need to take a look for, all right? If I'm looking to take sells counter trend to this 4-hour bullish order block here, this is exactly what I want to see. I want to see price action create this change of character right here. Why this low? Because price action has created a sell to buy, creating a higher high. And if price action is going to be retesting this level, great. I can look to enter a sell because this is one of the criteria, right? The fifth step here, read it, retest the change of character to take a trade. So the moment price taps into this area, you can take a sell right here, putting your stop loss above the structural high that caused this break lower. And of course, you can look to target lower prices for maybe a 1-2 RR or perhaps a 1-1.5. Doesn't matter. All you gotta do is take partials along the way. You know the style that I love to trade. 20 pips, 25% partials. As it goes higher, 50 pips, I take another 25. Another 50 pips, another 25%. Then let the rest run to full TP. So of course, let's say we have a 1-2 RR. Let's see how the trade would have played out. As you can see here, price action continues dumping very, very nicely for about a 1-1.5 RR, about 115 pips. Right, price continues dumping, and at this point, you would have already secured 75% of your partials as of the break even. Right, so this is when you're taking a counter trend trade towards the fair value gap. Now, back to the main point here on the 4-hour time frame, you can see that there is a bullish fair value gap, and so ideally, we are looking to buy in this fair value gap. So on the 15-minute time frame, what can I see? Price action is starting to slow down, which is one key indication. Okay, so what am I actually looking for here? So let's say you have closed out this trade, you have taken partials on this trade, as of the break even, you're letting this thing run to 1-2, right? Somewhere around here. Let's say price starts to create a change of character here. Now, this is a little bit more complicated, but pay close attention. As you can see, price has created a low, created a high, right? Now, why did I mark this out as the high? Because this was the lowest point in price came into before retracing and then coming lower, breaking past this low with a wick. And as I've mentioned in my market structure video, what you want to see is if you are looking for continuation sells, you want to see a body candle close. But here, we have a wick candle close, telling us that there is not enough volume for price action to continue pushing, and it might have a larger retracement. And of course, that's exactly what price did. Price created a bullish change of character instead, which is in line with what we want to see, because this is a bullish 4-hour fair value gap. Price creates a body candle close above this 50-minute level. What we want to do here is take a trade of the change of character level right here, stop loss below the low here to target a 1-2 RR. Same thing. A 1-2 RR is my standard risk to reward ratio that I'm looking to target, and let's see how this trade plays out. Price smash full TP. So like I mentioned, this trade downwards to retest the fair value gap can be taken as a counter trend trade. But of course, since we are in a higher time frame, 4-hour fair value gap, which is definitely stronger than any 15-minute price action that we see, we should respect that. And once we see confirmation that aligns with your 4-hour fair value gap, this is how you execute it. By following the steps I've mentioned earlier on. 5 steps. Number 1, identify your higher time frame FVG. Number 2, wait for price to tap the fair value gap. Number 3, drop down to your lower time frame. In this case here, we have the 4-hour, so therefore I drop to the 15-minute time frame for my lower time frame confirmation. Number 4, wait for a change of character with a body candle close, which happened right over here. Once price retested with the very next candle, I entered a buy with stop loss below the 15-minute low, targeting higher prices or 1-2 RR. And this is how we do it. Now let's take a look at one more example. This time we are on the 1-hour gold chart here, and we can see that price action is clearly in an uptrend, and therefore we're looking for buys, right? Very, very straightforward. If you're in an uptrend, we look for buys. So in this case here, I've spotted a 1-hour fair value gap as seen over here. A 3 candlestick pattern. Once again, let me refresh your memory. Candle 1, candle 2, candle 3. Top wick of the first candle and the bottom wick of the third candle are not touching. Close, but not touching. And therefore, I mark out this fair value gap. So, if price action wants to continue going bullish, and for me to look for buys, I need to see price action respect the fair value gap and then give me that change of character that I mentioned earlier on. So let's see what price action does here. Price completely dumps through the 1 hour bullish fair value gap. Body candle close below it. And like in the slides I mentioned earlier on, if you see a body candle close below a fair value gap in a bullish scenario, there is going to be an invalidation of the fair value gap. It cannot be used anymore. It's broken. So you won't be using this as a potential support area to buy. So now, of course, I need to see what price action is going to do, because at this point of time, price action is still bullish in terms of structure. We have a high, we have a low, we have a high high. Price has already formed a higher high. So we have to be patient. And what does price do next? Price creates a fair value gap. So when you see a bearish fair value gap on the 1 hour time frame, even though market structure is bullish, we still can potentially capitalize on sells. Now, what do I mean by this? Let me show you exactly how we'll draw this. In this case here, we have candle 1, candle 2, candle 3. We have a 3 candlestick pattern again. Bottom wick of the top candle, or of the first candle, and the top wick of the third candle, they are not touching as well. Gaps right over here. And therefore, this is now a bearish fair value gap. So let's see what price does next. Remember, we need to wait for price action to tap into the fair value gap, right? Next candle, we tap into it. So on the 15-minute time frame, what can we see here? Price action has created a test of this fair value gap. Now, we have a wick above the fair value gap. But as I mentioned in the slides, wicks can still be considered as a respect. As long as there's no body candle close above, this bearish fair value gap is still valid. Alright, and therefore, I'm still looking to use this area. So, take a look at, I've dropped from the 5 minute, from the 1 hour to all the way to the 5 minutes. Same thing. 5 minute, 15 minute, they all never broke above. So, on the 5 minute time frame here, you can see, we have created a change of character where, let me mark it out. Price has created a move lower, higher, lower, higher, creating that high high, higher low, high high. Now, price action decides to continue to break below this low. And this low here is our higher low. And when this happens, there's going to be a change of character. And we have a body candle close, which is very, very good. So I can mark it out right here. Body candle close. All right. So what is the last criteria for you to take a trade? A retest. Price retests it like this. And therefore, you can take a market execution sell right here with stop loss above the swing high on the 5 minutes and take price down for a 1:2, just like this. Okay, a 1:2. And let's see how this trade would have played out. Price instantly dumps here during the London session for a 1:2 RR. So this is how you can really go ahead and utilize fair value gaps, making sure that you understand the difference between a respected fair value gap versus a disrespected fair value gap, or a fair value gap that has been invalidated with a body candle close. And you can use these 5 exact steps to catch trades on a daily basis on the different pairs that you're looking to trade. Alright, so I hope you guys here learn and appreciate all these examples. Go and practice it, back test it, forward test it, live test it, so that you are familiar with the strategy, so that you can use it to your advantage to make money in the markets.
Welcome back to the DAC course. Today, we'll be talking about liquidity as a concept. Learning liquidity is one of the main things people tend to forget when learning smart money concepts. And it is an absolute must when it comes to becoming a profitable and consistent trader in the markets. Not only does it help you avoid losses, but it also increases the probability of the trade setups that you take every single day. I personally use them every single day when I trade live on the streams with you guys. So now, let's go in depth into how you can use this to your advantage to make money.
Liquidity is one of the difficult concepts to grasp as a new trader. So I'm going to break down exactly what it means and what kind of liquidity there is in the market and how you can use liquidity to your advantage. I use this concept all the time on my stream. So ready up, pay close attention and let's get started. Now, what is liquidity? Liquidity refers to the balance of buy and sell orders at different market price levels. Now, let me give you an example. A liquid market is where buyers meet sellers and sellers meet buyers, and therefore transaction occurs. Okay, I'll have an illustration in a short little while, so bear with me. Now, an illiquid market is where the buyers do not meet sellers at the right price, or they do not want to transact at the right price, and therefore no transaction occurs. And therefore, it also becomes an illiquid market because there's nothing happening in the market. There's no buying or selling happening. All right, so now let me dive right into an example right here. In the liquid market, there are always buyers and sellers at several different price levels, creating a ton of trading volume. Right, so in this specific example here, you can see there are many different buy orders and many different sell orders. And at each of these buy orders, there is a sell order that is being met. And therefore, a transaction happens, and therefore this is considered a liquid market. However, on the other hand, you can see that there is not enough sell orders or buy orders to fulfill the criteria. Why? Because the buy order here is not being met with a sell order. And likewise, like the sell order here is not being met with a buy order. And therefore, this is not a liquid market. This is an illiquid market because every buy order is not met with a sell order. One key thing to note is that whenever you trade the forex market, there always has to be an equal and opposite order in the market for the trade to happen. So let me give you an example. Let's say you are a big bank and the big bank wants to buy Euro US dollar at 1.1000. Alright, and if there's insufficient opposing orders at the liquidity to fill their orders at 1.1000, they'll get a fill at a worse price than intended due to slippage, causing them to lose money just by placing an order. Of course, nobody wants that. The big players need a ton of opposing liquidity to trade against to reduce the amount of slippage that they experience. So let's say in this case here, price action wants to, or let's say the bank wants to buy at 1.1000, right? But as you can see on the right, there's no orders, and therefore their buy actually get executed here instead, where the buy orders meet the sell orders, resulting in their order to be filled, right, for their buy position. Okay, remember, like I mentioned, as I said before, whenever you're looking to trade, there has to be an order that is equal and opposite in the markets in order for your position to be filled. All right, so to simplify, all right, liquidity is pending orders that are ready to be filled. They're just waiting to be filled. The moment price matches that price point, then a transaction occurs, and therefore liquidity has been collected. All right, so now let's go through what are the different types of liquidity in the market. So over here, you can see I've drawn out for you 5 different types. Number 1, structural highs and lows. Number 2, swing highs and lows. Number 3, equal highs and lows. Number 4, above or below the trend line. And number 5, session range liquidity. All right, so I'll be explaining each and every one very, very carefully. So make sure to pay close attention and let's get right into it. Here you can see for structural highs and lows, right? Each time you're in a bullish market, price action is creating higher highs, higher lows, and higher highs and higher lows. And when you look at a bullish market, the most recent higher high and the most recent higher low, these are your liquidity areas. Why? Because there are stop losses sitting below or above the swing highs and lows, as mentioned over here, right? This low here and this high over here, right? People are looking to take their profits here, or people are looking to impulse buy towards the upside with their buy stop orders, for example. And for this area right over here, this is where they're going to have their stop losses placed if they're in the buys, because if price comes down, they want to get out of the trade. That's why these are very, very good area for price to come and test or collect orders before moving the market in its intended direction. These orders here below this low have not been filled, and therefore a very good area for price to come and test. Likewise, in a bearish market, right, you are going to be seeing lower highs and lower lows, and these are going to be your liquidity areas, right? Because as price is continuing towards the downside, you're going to be seeing a creation of low highs and lower lows in the markets. And when you find yourself in a bearish market, I want you to look at the most recent lower high that has been formed and the lower low that has been formed. all right? Because these areas here are going to be where a lot of the stop losses are sitting, above the high or below the low, once again. So these are very good areas for you to target in terms of taking a trade. Let's say if you're going counter trend in a downtrend, you want to target the most recent lower high. If you're going pro trend, then you want to target the most recent lower low, right? Because these are where prices will tend to reverse. So taking profits there will be great, right? I'll explain more in a short little while. Now, for the next one, right, we are going to have swing highs and lows, right? So it's also part of your structure, but yes, this is called swing highs and lows. Now, how do you know what is a swing high and how do you know what's a swing low? Okay, a swing high forms when a reversal happens, right? And this happens in a uptrend. Okay, price comes up very, very fast and then comes down very, very fast as well, very, very aggressively. So it reverses sharply. And this normally creates a change of character at this point. And once price action breaks past this low right over here with a change of character, then you'll know that this is going to be more than likely a reversal. And therefore, this brand new high that we have just created right here is going to be an area where we call it a swing high. Those people shorting from here will have their stop loss above this high because they will not want to be stopped out, right? Or they want to be stopped out for that matter. They want to be stopped out in case they are wrong in their direction. And that's why a lot of stop losses are placed here. And of course, there are also going to be people placing their buy stop orders, right? To capitalize on breakouts. If let's say price were to break out above this swing high. Right, so these are very good areas, or this high here, for example, is a very good area for price to come back to revisit in the future, right? If it needs to collect liquidity, right? Same thing for swing lows, right? It is formed when a reversal happens, and it happens in a downtrend, and it happens very sharply. So, for example, price is coming down like this, right? Creating lower lows, lower highs, lower lows, and then price continues to push higher. And of course, in the process, it creates a change of character, right? So when this happens, people that are looking to buy will be placing the stop loss below this level here, right? Because if they are wrong, they want to get out of the trade and not take too much of a loss. And that's why a lot of stop losses will be sitting below these lows right here. Then one more time as well, there's also going to be a lot of sell stop orders below this low for those breakout traders trying to capitalize on volume. Let's say price starts to dump all the way down. This is exactly where they will look to enter at the lows, just right below the lows, to ensure that, let's say they will take a sell trade, right, price is going to come down. But do take note, these areas are going to be area where price could potentially reverse from. All right, so that is for swing highs and lows. Equal highs and lows, you can see here, there are resistance and support areas, like as I've drawn in my drawing right over here. Right, they're normally seen as resistance and support for the equal highs itself. They look like resistance, basically like a double top or a triple top, right? Basically, where you have many different areas touching the same area or the same key zone multiple different times, failing to break above. All right, and this is when you start to see that, you know, people would draw their resistance boxes and they'll look to sell from there. Okay, and this is where the market likes to trick people, right? They think, okay, you know what? Let's go create equal highs at this point. People are going to be placing their stop loss above this equal highs right here. All right, and this is usually what happens. Price comes down and then pushes back all the way up, taking out all the stop losses sitting over here, which is a very, very good way to take out all the sellers that are selling at this double top or resistance area. So this is how price tends to generate liquidity, or like collect orders that have not been collected before pushing the price down lower. Same thing for equal lows, right? You're going to have a support level where price has been tested multiple different times, failing to break through that key area, right? And people are going to be looking to buy at this support level, right? And of course, as price continues towards the upside, right, people will be placing their stop loss below the low, just in case, let's say, price were to take them out and continue going lower. But of course, the market use this as areas for them to visit to collect all these stop losses before pushing up in its intended direction like this. So for example, if price was up here, price would come down, take out the orders, and then continue pushing higher. So this is what price action would normally do when you see an equal high or an equal low. All right, and one thing that I also like to say on stream is trendline liquidity, right? This normally happens when you have multiple touches connecting the higher lows in an uptrend, or multiple lines or multiple touches connecting the highs in a downtrend. So just like this, right? It looks so beautiful. People will be looking like to place their stop loss below this area because you know what? It is a very good area for price to bounce off, right? Trend lines. That's what you guys learn when you first start trading, or that's what people like to teach you, right? You are going to be placing your stop loss below the trend line or above the trend line because it should respect the trend line. And that's what the market loves to see. Okay, the market loves to see people do that. Why? Because there could be a lot of orders below this area to make sure that those people that are in the buys will get stopped out, and those people that are in a sell right here, they place the stop loss above the trend line to ensure that they don't get stopped out. And this is what the market will do. For the bullish scenario, price action, what they normally do is they will take out all the stop losses before continuing going higher. Same thing for trend lines. You can see here, trend lines towards the downside. You can see people will be placing the stop loss above this area here, and what the market will do is that they will push price higher to take all the sell stop or all the stop losses out for those sellers and continue going lower. All right, this is why this is called trendline liquidity, because there are orders sitting above or below the trend line. All right, now for the very last one here, we are going to have our session range liquidity. Now, ranges can be formed during the Asian, London, or the New York session. All right, every single day, right, you can see a range formed during the Asian or the London or the New York session. For example, if let's say Asian has a lot of volume, it pushes very high, right, or pushes very low, and then London, it starts to consolidate because all the volume has already been pushed up and it needs to accumulate orders once again, and that's when you normally tend to see a range. All right, and during these ranges, or during the session itself, you can always mark out, for example, if let's say you're trading in the London session itself, you want to go back to see what the Asian session has done. If it has created a range, then what you want to do is mark out the highest point in price in the range and the lowest point in price in the range. Right, like I mentioned over here, these are going to be where you will have your sessions high and low. Right, these are good areas of liquidity because people that are trading within the sessions, if they're looking to sell at the top of the range or buy at the bottom of the range, they'll be placing their stop loss below these areas to ensure that they have some sort of risk management. And of course, the market will look to target these areas perhaps in the next upcoming session, right? Because the market doesn't go up in one line or doesn't go down in one line. It likes to go up and down to collect orders before moving in its intended direction. All right, so that's why we have strategies like the Asian sweep strategy, because we use the Asian high and the low to take a trade. Right, we want to see price take out the high first before coming down to take out the low. That's how the Asian session liquidity range works. All right, so now, how do you use liquidity to your advantage? Number one, you want to use these areas of liquidity to take profits or take partials at. Right, as I mentioned, price action likes to reverse after taking out liquidity or taking out equal highs, equal lows, swing highs or swing lows. You tend to see a rejection after that. Why? Because price action has already collected the orders. For example, if let's say you're in a buy, right, and you are buying towards a swing high, when people are placing their stop losses at the swing high for their sells, or those people who got into sells, what would actually happen is that their stop loss actually becomes a buy stop, right? And this activates a buy in the market. But of course, to fake people out, the market loves to reverse right after taking out liquidity. And that's why you want to take profits or partials at this area to secure money and put it into your bank account. You want to secure these profits at key levels of liquidity, just in case it completely reverses. Okay, and number two, you can use liquidity to give you extra confirmation before taking a trade, right? And I'll give you a few examples now, so pay close attention. Now, as you can see here on the chart, I have actually marked out a equal low that has formed right over here, the equal low right over here. And what did price do? If you take a very close look, price here created the equal lows, and what did price do right after? It dumped into it, creating bearish structure. But shortly after, price action reversed towards the upside, creating a bullish change of character right here. And once it created the bullish change of character, let's say you wanted to enter, you can enter at the order block that was created, the sell to buy. Once it taps back in, you can enter here, or if you want to enter at the bullish engulfing candle here, you can enter it as well at this point here. Alright, stop loss below the swing low, which is where the sell to buy happened. Alright, your target a 1 to 2 RR, for example. Right, so this is one good example of a use of equal lows to generate liquidity to trick people into thinking that, you know what, this area here is going to hold, I'm going to look to buy. So what you should do is wait for the equal lows to be swept and then look for the confirmation, like a change of character, before taking a trade. Alright, now let's go to the next example right here. For this example here, you can see that price has created a bearish change of character with a wick at the first point right here. Right, you can see we have created a change of character with a wick, no body candle close, which tells us that, of course, like I mentioned on the stream every single time, right, if you don't see a body candle close below, it tells us that the market could potentially want to see a deeper retracement, which it did. Right, price came all the way back up to see a deeper retracement before dumping lower with a body candle close, creating a BOS. All right, so at this point in time here, you can see this wick here, or this equal lows here, right, were actually taken out with a body candle close. Now, you can see right underneath this area here, this low that was created from the break of structure towards the downside created a low that is equal to this low. Therefore, you are able to draw a straight line. And a lot of people think, oh, you know what? This has created rejection of this area here. This is going to be a very strong support. And because it is a very strong support, people are going to buy. But no, what I'm going to do instead is follow my confirmation. Look, okay, we have change of character. You have ABOS. I'm going to take a sell here with stop loss above the order block high to target first the liquidity point and then a 1 to 2. So at this point, when I took a sell, okay, yes, cool, price came into a little bit of a drawdown and then started to dump lower. And the moment price action starts to break below this liquidity point, this is exactly where you want to take partials and shift your SL to break even, just in case price comes back and reverses. So this is where you should be taking your partials at these equal lows. And then you can shift your SL to break even and let the remaining run to full TP. All right, so let's take a look at one more example before I sum it up for you guys here. Now, in this case here, we have a 1 hour chart, right? The OB has created, the chart has created a 1 hour bullish order block over here, and you drop down to the 50-minute time frame. And this is exactly what you see. All right, price rallies towards the upside. And as you can see here, price action has actually tapped into a liquidity where there's equal lows over here. As you can see here, low here and low here. These two are equal lows, right? So what did price do? Price came down, take out the equal low, came down, tap into a higher probability, higher time frame 1 hour order block. After that, what did price do? Created a change of character. Okay, so this change of character happened to be with a body candle close once again. So as price comes back down to tap into the 50-minute bullish order block, you can take a buy here with stop loss below the 50-minute swing low. Now, where do I target? I target the swing highs. Why? Because remember, I mentioned in the examples earlier on, swing highs, swing lows are where people tend to place their stop loss. If they took a sell from here, they'll place their stop loss here. Those people that want to take an impulse buy, they'll place their buy stops above this area here. So therefore, this high has a lot of orders sitting above this swing high, waiting for price to come and collect these orders before going in its intended direction. So in this case here, as you can see, price went straight into profits, great, right? We take our full profit at the swing high, avoiding the entire catastrophe that happened right after price completely dumped. As you can see, doesn't mean that yes, you break the swing high, yes, we're going to continue going higher. You need to wait for confirmations. And in this case, price completely dumped lower after collecting the liquidity past this swing high. All right, so I hope you guys here understand everything that I've done and gone through, right? And if you don't understand, please go ahead and rewatch this video as many times as possible. If you're unclear of anything, always text trade ideas. Me and Thomas, we are here to respond to your questions.
Welcome back to the DAC course. Today we'll be talking about multi-time frame analysis. One of the most important factors as to why I have an extremely high win rate of 80+% year to date. If you don't have an overall outlook as to how the market is moving, you will most definitely get your direction wrong most of the time. You may have been stuck on the 5 minutes or the 1 minute charts looking for trades. Well, it's not an issue to trade on those time frames, but let me show you how to spot A+ setups using multi-time frame analysis so that you can use your high time frame and your low time frame together. So let's get right into the video.
Alright, before we get started with the multi-time frame analysis, I want to say that make sure you watch all the previous videos that we have already uploaded so that you guys here get the full picture and understand the concepts before using multi-time frame analysis. All right, multi-time frame analysis is one of the core things that I use to ensure I have a very high win rate, like I mentioned in the intro. So pay close attention and let's go. Now, what is multi-time frame analysis? It is basically top-down analysis that tells you that you need to use the higher time frame and the lower time frame together to give you a full picture of what price is currently doing. Now, why is this very, very important? Why can't I just take the 5-minute time frame and just trade the 5-minute time frame only? Right? Because it gives you information of what the higher time frame is doing and the lower time frame is doing to give you an overall idea of what price is doing. For example, let's say if the market is going bullish on the higher time frame, but the lower time frame is bearish, what do? That way you know exactly how to navigate the markets on the lower time frame compared to the higher time frame, and whether you're pro trend versus counter trend. All right. So, like I mentioned, it gives you the ability to take trades in the right direction. Number one, and number two, doing multi-time frame analysis, or better known as MTA as well. It allows you to get precise entry with smaller stop losses, and it also gives you extra confirmation for A+ setup. Right. So now let's go ahead and discuss what time frames should you use. All right. Now, this is my personal way of doing top-down analysis or multi-time frame analysis. Right. I normally do it from the weekly to the daily to the 4-hour, 1 hour, 50 minutes, 5 minutes, and then the 1 minute. Now, why I put optional here, because I'm no longer trading the 1 minute time frame, as I've discussed with you guys here live on stream and inside the premium zooms. The reason why I don't do the 1 minute anymore, because it's too much noise, and I personally do not need the 1 minute time frame to win trades. All right, and I'm no longer hyper scalping anymore. So with that being said, I normally do from the weekly all the way down to the 5 minute time frame. Now, key thing to note is that I personally use a minimum of 3 time frame alignment before I take a trade. So that would mean, for example, if let's say I'm analyzing the chart on the 4-hour time frame, right? Let's say it's bullish. The 50-minute time frame is bullish. 5-minute time frame is bullish. I skip the 1 hour. If you take notice, I skip the 1 hour, but I have the 4, 15, and 5 all bullish. That's when I take a buy trade. Now, if anything more, let's say the daily and the weekly is also bullish. These are extra confluence for direction, as mentioned over here. All right, so minimally I use 3. Anything more is better. So let's go ahead and jump right into an example as to how you can use multi-time frame analysis using a trade here. All right, so let's take a look. Let's just take a look at this current image here. This is a daily time frame chart, and you can see, right, I'm not sure if you recognize this, but if you've been trading long enough, I believe that you understand that this is gold. All right, but it's okay, no worries. This is a gold chart on the daily time frame, and as you can see here, I've marked out in orange circles where the lows and the highs are. What did price action do? Okay, first thing that I want to do here is identify market structure. Right, I want to identify market structure, and what I noticed is that price created a higher low followed by a higher high, and right afterwards price came down and created a change of character, and this time with a body candle close below it. So when you have a change of character and price comes and create this low here, this low is now a lower low compared to this low here, which is a higher low. And therefore, this tells us that there is a potential bearish reversal happening. All right. So right now on the daily time frame, I'm bearish. Okay, so just keep that in mind. And in the process, we've also created a daily bearish order block right here. The last candle that created the highest point in price before breaking structure. So this is where the bearish order block is. And now let's drop down to the 4-hour time frame. And as you can see here, the exact same thing, right? We have the low, the high, the lower low on the daily time frame, and the in the daily order block that I've marked out over here in the big blue color box. And if you take a very close look right here, right, this is the current 4-hour price action. After price tried to break above the daily bearish order block and failed, price created a move towards the downside here, breaking past the most recent 4-hour higher low. This creates a bearish change of character, and this thing here was created with a body candle close, meaning that there is strong intentions for price to potentially continue retracing towards the downside, right? And as you can see here, price came up and tapped into the order block. So this is my sign. I dropped to the 1 hour time frame because now the daily is bearish, 4 hours bearish. Moving on to the 1 hour time frame, you can see that price action over here has actually tapped into the 4 hour bearish order block and created a move towards the downside. And if you take a close look here, initially as price was pushing up, price created a bullish fair value gap. And right after that, it was followed by an invalidation of that bullish fair value gap on the 1 hour, creating a 1 hour bearish fair value gap. Once again, 3 candlestick pattern, 1, 2, and 3, right over here. The bottom wick of the third candle, or sorry, of the first candle, and the top wick of the third candle has not created a touch between the 2 wicks, and therefore this is a bearish fair value gap. And once price taps into it, this is my sign to drop down to the 15-minute time frame. All right, and on the 15-minute time frame, what can I see here? Right, this was a tap into the 1 hour bearish fair value gap. So I noticed that before price actually tapped into this fair value gap, price created a bearish 15-minute change of character, which is another confirmation for us. Right now you can see 4 hour, the 1 hour, daily, they are all bearish. So that's 3 confirmations already. But since I like to trade on the 15 minutes time frame or the 5-minute time frame, 15-minute time frame will be great to execute this trade. Now let me explain exactly how this trade was taken using multi-time frame analysis. So you can see here, price has created a change of character. Great. As you guys already know, gold has been extremely bullish, and for us to really take a sell, I will need to see an extra confirmation, which I'll be going through in the very next video on confirmation entries. But here we can see that there is a change of character. I waited for a BOS with a body candle close above right here. Right, it's very small, you can't really see it, but yes, there is a body candle close right here. The moment price retested it, I took a sell here. Stop loss above the 15-minute high, targeting a 1:2 RR. And therefore, you can see this trade played out very beautifully because all the time frames from the daily, the 4 hour, the 1 hour, and the 15 minutes, they were all bearish. And that's why I mentioned, right, you need to do multi-time frame analysis to ensure that you understand exactly what is going on in the markets, right? Whether you're pro-trend or you're taking a counter-trend trade. In this case here, we are taking a pro-trend trade. Therefore, having a win very fast, right? Price just basically melted all the way down to full take profit. All right, so let's hop onto the chart and take a look one more time at how we can identify multi-time frame analysis and the directions of the market so that you guys here can do it for yourself every single day you look at the charts. All right, here we have the GBP JPY chart on the daily time frame, and actually I want to go up one time frame higher. Remember, I can start from the weekly if I want to as well. So on the weekly time frame here, we can see that price action has actually broken through this low, creating a change of character. All right, and therefore in this case here, we can see we have created a change of character with a body candle close, telling us that there is a very strong potential for price to continue lower for this matter. And you can see at the same time, price has also taken out this low right here. So these are potential areas for price to retest. But all I know right now is that price action is bearish on the weekly time frame. Now, let's take a look at the daily time frame. Now, just keep that in mind, weekly is bearish, okay? Now, daily, what do we have here? We can see that price action has created a move towards the downside here. And this is also creating a buy to sell with multiple different fair value gaps over here. All right, we've got a bearish fair value gap here. You also have a bearish fair value gap right over here. And most importantly, you can see price action has started to invalidate these fair value gaps right here. Now, you may be asking, Nick, which fair value gap do you use? Exactly. I also don't know. So that's why we need to take a look at what price action is doing on the lower time frame before we take a trade. Right? This is why multi-time frame analysis is so important. But yes, even though yes, we are seeing bullish price action here, price action is still overall bearish. Why? Because we have created a buy to sell. And as you can see, right, with this buy to sell here, we have a swing high and swing low, and therefore we are still bearish. So now, with that being said, let's drop down to the 4-hour time frame. Now, I deleted this fair value gap because price has already broken through it. So let's take a look at the 4-hour time frame here. And on the 4-hour time frame, you can see that price action has this daily fair value gap, which is also overlapped with a 4-hour bearish order block. Right? This is a 4-hour bearish order block right here. Okay, as you do your multi-time frame analysis, you can see that price action is a little bit messy, right? But since right now price action is reacting off this area, I'm going to be looking for price to, I'm just going to remove this daily fair value gap above. We can always draw it the next time when price comes into this area. All right, so this is the area I'm focusing on. So of course, assuming that we are still bearish, because we are, right? You can see price created a 4-hour buy to sell as well, resulting in a swing high right over here and a swing low right down here. Okay, everything else in between is considered internal price action. So 4-hour is also bearish. So there's the minimum of 3 multi-time frame analysis criteria that have already been met, right? Your weekly bearish, your daily bearish, and most importantly, your 4-hour is also bearish. So now, of course, like I mentioned, any other more or any other extra confluence is just going to help our trade be even more high probability. So let's take a look here. So as price came into the 4-hour bearish order block, price started to range, and this is when you can drop down to the 15-minute time frame, and you can see price action came into this area during the Asian session. And this was a trade that we actually took on the second week of the Friday of August. All right, and you can see here, price actually has taken out liquidity at this point. Equal highs taken out. All right, this is the liquidity that's been taken out. And right after taking out the liquidity right here, price actually created a change of character. Now, if we see a change of character right here with a wick candle close, this tells us that this is going to be a very, very weak closure. And that also tells us that the market is expecting a deeper pullback, which it just did. So how can we actually capitalize on a potential sell here? Now, like I mentioned, right, on the 15-minute time frame, you can see price action has been extremely, extremely bullish, right? Coming up, coming up, coming up. Huge, huge candles towards the upside and tapped into the 4-hour bearish order block, which is also where we are looking to sell from. So for me to capitalize on this proper reversal, right, since the 15-minute is counter trend going bullish, for me to confirm that we want to continue lower, I want to see price action create a BOS, which we did right over here. Now, why is this a BOS? Let me zoom in so that you guys here can understand exactly what is happening. All right, you can see here, let me draw how structure has formed. Price has moved towards the upside, came back down, moved towards the upside, creating a lower high because this high did not break above this high, and then pushing down once again with a body candle close. Now, all I need to do is wait for price to retest this area here before looking for potential sells. So what you could have done here is just take a sell from this point here, the moment it retests, and give you a bearish engulfing candle. You can execute a sell right here with stop loss above the 15-minute high, targeting once again a 1-2 RR. Of course, if you are looking to swing it, you can swing it for higher. And there you go. This is how you actually catch a super solid trade for a 1-2 RR, right? Waiting on the bearish engulfing candle. All right. So the weekly time frame was bearish, daily time frame was bearish, 4-hour was bearish. I straight away jumped to the 15-minute time frame to look for my entry criteria here. And you can see at this point in time, right, price action on the 15-minute time frame was initially still bullish until we started to create a change of character, which now aligns with the rest of the other time frames that I have analyzed. Now, it turned from bullish to bearish. And therefore, this makes it an extremely high probability trade. And that's why the trade here ran so smoothly towards the downside. All right, so I hope you guys here understand exactly how I've done multi-time frame analysis. Of course, if you don't understand, watch this video again and again and again. And if you have any questions, let me know at Trade Ideas or talk to Thomas in Trade Ideas as well. We both have the same understanding of the markets. So with that being said, make sure to go and practice this yourself. And if you still don't have enough practice or you don't have enough examples, then make sure to come to the streams because I do this every single time I'm on stream. I make sure that you guys here understand what the multi-time frame analysis is for a certain pair before I take a trade on it. All right, so with that, I'll see you in the next video where we will be talking about the confirmation types.
Welcome back to the DAC course. In this video, we'll be talking about confirmation types that you need to see before taking a trade. On stream, you normally see me do different types of confirmations that I use before I enter a trade. And I will be breaking down exactly why I do that in this video. We all need to be prepared for different market scenarios, and these confirmation types will help you achieve just that. So make sure to pay close attention and take down notes. Let's get right into it.
Alright, so this video will be talking about confirmation types. And of course, we are going to be going deep dive into what I personally use to look for an entry, whether we're a pro trend or counter trend. And let's go right into it right now. Now, as you can see here, what are the different types of confirmations? Now, I'm assuming right now that you already watched all the videos that we've uploaded previously, because these are very, very important, from your multi-time frame analysis to your market structure to your order blocks, fair value gaps, so on and so forth. You need to understand these before coming into the confirmation types. All right. So in market structure itself, you know that there are normally two types of trends: pro trend, counter trend. Alright, right, the pro trend as well as the counter trend trade, right? So when you're pro trend, you are trading with the trend. For example, if let's say you are 4-hour bullish, right, on gold, and of course you're looking for a potential buy, that is when you are pro trend, because you're going with the trend. Now, if let's say you're looking to take a sell in a bullish market, then this is when you're going against the trend. Now, I have two different ways of identifying how I can enter, and these are my confirmations before I execute a trade. So pay close attention. Okay, now for pro trend confirmations, this is exactly what I want to see, right? For example, normally the way I take trades is I always take trades of either number one, a order block, or number two, a fair value gap. Most of the time, it comes off a order block itself. So price taps into the order block, meets all the criteria, multi-time frame analysis is aligned, right, bearish, and price has now tapped into my 15-minute, let's say, order block right here. So what I want to see before I take a trade short in line with a bearish high time frame and lower time frame confirmations using the multi-time frame analysis, I want to see what? A change of character with a body candle close. Why do I want to see a body candle close? Because of the fact that when there is a body candle close below this low here, for example, right, because we are shorting, you want to see a body candle close below the most recent higher low. This will tell us that the market has intention and wants to continue lower, because price has pushed price below this key level here, which is the higher low, and stayed below it, telling us that there is a strong indication that price action wants to continue lower. So this is the first step for the confirmation, number one. Number two, once the change of character has been created with your body candle close, you want to wait for the retest of the change of character level. That's number two, step two, once it retests. Okay, so what you can do here is set alerts, like how I normally do on stream. Once it comes back and it taps into my alert, good. I'll be very focused right now, because of the fact that this is where the third step comes in. You want to see a creation of a bullish or a bearish engulfing candle to capitalize on a trade. In this specific scenario here, I'm going to be looking for a bearish engulfing candle. Why? Because I'm looking to sell, right? I don't want a bullish engulfing candle to sell the market, right? I want a bearish engulfing candle because it tells us that the market has volume to push lower, right? So once I see a bearish engulfing candle, so let's say for example the bearish engulfing forms here, right? After the bullish engulfing, the bullish candle forms here, bearish engulfing candle forms, it closes. I execute a position with stop loss either above this high or above this high right here, right? The structural points to target a 1 is a 2 RR, right? Now, the areas where I target doesn't have to be strictly 1 to 2, as you guys notice, right? Sometimes my signals, they can be even higher RR, like a 1 to 3, 1 to 4 RR, because of the fact that I'm looking to turn a potential intraday trade into a swing trade if it continues running pro trend, right? Because when you're going with the trend, you're more than likely to see more pips in your trade because price is running further in your direction. When you go counter trend, which is what I'll be talking about next, you will tend to see a bit lesser pips. You want to secure more out of the trade as much as possible because you're going against the trend, and going against the trend already in itself is risky. All right, so like I mentioned, let me just recap. For pro trend, you have 3 steps. Number 1, create a change of character with a body candle close below. Number 2, wait for a change of character, a retest, and once it retests, move on to step number 3. wait for price to create a bearish or a bullish engulfing candle. In this case here, bearish engulfing candle to take a sell with stop loss above either this high or this high and target a 1 to 2 or a structural low for you to continue to break past that low, right, and create a lower low. All right, now for a counter trend, this is the opposite, right? So let's say you are over your high time frame, like your multi time frame analysis, your MTA is bearish. In this example here, you can see price has come down, created a bearish move. So overall high time frame is bearish here. But then you start to see, okay, you know what? It may be time for a pullback. And you start to see price create a change of character. Okay, so for me to take buys in a downtrend, I need to see 4 steps. 1 additional confirmation to confirm a reversal. First step, I want to see a change of character. And once a change of character happens with a body candle close, ideally we see a body candle close, then we look for a retest of the change of character to continue breaking the high that caused the change of character right here. And when this happens, you create a BOS. Now, the difference that I mentioned in the past, right, in the video on market structure, between change of character and BOS, change of character indicates a potential reversal in the market. A BOS confirms the trend. It confirms that it's going in that direction. So in this case here, once price starts to break above this high, it confirms that price action wants to continue higher. And what I want to see here is a BOS with a body candle close before a retest to take a trade with stop loss below the swing low, targeting a 1 to 2 or an area where there's liquidity or an area where there's an unmitigated order block like this right over here. Okay, so let me recap. There are 4 main steps for a counter trend trade. Number 1, wait for price to create a change of character in the opposite direction of the trend with a body candle close. Number 2, you want to see a retest of the change of character level. Number 3, you want to see price create a BOS continuing towards the upside, right, in the opposite direction of the trend with a body candle close. Body candle close, good. Last step, wait for the retest to enter a position. Stop loss below the low, target the highs. Simple as that. Okay, so now let's go into 2 examples that I'll be showing you guys for a counter trend trade and a pro trend trade so that you know exactly the confirmations you need to execute a trade. Alright, let's take a look at this example over here on the 1 hour time frame on GBP JPY. Price action has been on an overall downtrend. Like, this is to skip the MTA here, but you can see definitely on the higher time frame, if I zoom out on the daily time frame, we can see that we have created a change of character plus BOS here. So definitely a bearish reversal that is currently in play right now. So hopping back to the 1 hour time frame, where you're going to be looking for a potential trade, this is exactly what you want to see. Now, for example, this current price action right here has created a move towards the upside before coming back down. Now, this has created a change of character on the 1 hour time frame. All right, so now, right now I'm just giving the context. I haven't got to the confirmation entry just yet, so pay close attention. Okay, so once you have created a change of character at this point with a body candle close, you can see that price action has created an order block. So once price comes and tap into the order block, this is where you want to pay close attention, because I'm going to be dropping down to the lower time frame here. And as you can see, after price tap into this area, we can drop down to the 15-minute time frame. And as you can see here, after price created this 15-minute tap into the order block, you can see price action has actually created a change of character at this level here. Now, why was the change of character at this level on the 15-minute time frame? Because you can see here, price created a sell right here towards the downside before creating a brand new high up here, right, tapping into the order block, right? And this high here did not break past this high, and therefore the swing low is here. And once price break below it with a body candle close, we have a strong 15-minute change of character. So that's criteria number 1. All right, so what you want to do is see price retest, and as you can see, price created a complex pullback. Great. And then what you can really go ahead and do is take a look at what the internal price action is doing here on a brand new day. As you can see here, this was what happened during the New York session. And after the New York session, price range, and you can see as price came back up into this area here, right, we started to create a change of character once again, a bearish change of character once this low here was actually taken out. All right, this low right here was actually taken out. And once price actually created the change of character at this point with a body candle close, which is our criteria number 1. What's the second criteria? I'm looking for a retest of that change of character level. Price gave us a very nice retest. And what's step number 3? We are looking for a bearish engulfing candle. And this candle here is a bearish engulfing candle. Why? Because this candle here closed below the wick of the bullish candle, right? Basically engulf the whole thing, and it's a way larger candle than this bullish candle. Therefore, this is a bearish engulfing candle, and I'm looking to take a trade here. Now, where can I put my stop loss? Stop loss can be placed above this high here, right, where you created the first change of character that happened to target a 1:2 RR if you wish, right? Of course, as you can see, how would the trade run? The trade would have run very, very nicely, right, during the Asian session, and you have smashed full TP, right? So like I mentioned, 3 steps. Number 1, change of character in the direction that you are going with the trend. In this case here is bearish, so you need to see a bearish change of character with a body candle close. So step number 2, retest, and once it retests, wait for a bearish engulfing candle to form, and then you enter off the trade once it closes. All right, so enter, stop loss above the high, right here on the 15-minute time frame to target a 1:2, and there you go. A very, very nice trade for a pro-trend trade idea. All right, so now let's take a look at the counter-trend trade idea. All right, let's take a look at this chart over here on gold, right? This is going to be a counter-trend trade idea. Right now, assuming that price action has already created a change of character towards the downside in a very, very bullish market, okay? As you can see here, gold has been rallying all the way from down here, all right? 26th of June, price rally all the way up to the 2.484 level. And of course, right now, on the 1 hour time frame, we have created a bearish change of character. 4 hour time frame as well, we have created a bearish change of character. So both 1 hour and 4 hour, they are bearish, right? Daily, we are starting to see a pullback here, right? Which is completely normal after creating a brand new high right here. So if you take a close look on the 1 hour time frame, you can see, right? Price has created a change of character at this point. And of course, if I'm looking to take buys on the way up, how can I actually capitalize on the buys towards the bearish order block to potentially sell from there? Let me show you how. You drop to the 50-minute time frame, and what can you see? Price action here has created a buy to sell, breaking past this low, creating a lower low. But right after that, what do we have? A change of character, which is our first main criteria for our confirmation to take a counter trend trade. Okay, so we have created a change of character right here with a body candle close. Criteria 1, check. Criteria number 2, I want to see a retest. Bam, a retest, very, very good. Now, all I need to do is wait for price action to create an BOS, breaking past this previous high, which is step number 3. And as you can see, price slowly came and break up above this high here with a body candle close. So now this becomes a strong BOS as well, which is our third step right over here. Now, what is the last step that I need to see before I execute a counter trade by a counter trend trade by right over here? I want to see price retest this level here to take a position. So once price give us this bearish doji, or like this bearish candle here, right over here, I wait for the next candle to tap into this area. So the moment price taps into this area, I execute a buy. Now where can I place my stop loss? I can place my stop loss below here or below here. Right, below here is absolutely fine as well, right? Because the fact is you already have double confirmation. You have a change of character, you have a BOS. And therefore, this tells us that the reversal, or at least the counter trend trade that you're about to take, is going to see a huge pullback on the higher time frame, and therefore we're going to be looking for a 1:2 RR. So if you place stop loss here, you have a trade right now that's running roughly around 7 pips in profit thereabouts. But let's say you take this trade here, you place your stop loss below this low with a order block right over here as your layer of defense, and your 15-minute structural low right over here. Right, your lowest point in price before price came and pushed up higher. So when you take this trade, place your stop loss here, aim on 1:2, and what can you see? Price almost stops us out, respects the OB, but I wouldn't consider this a respect. This is still disrespected, but price in the end still created a change of character like this with a body candle close, retest, continue even higher, smashing your full take profit. So this is exactly how you want to be utilizing counter trend trades, right? Because remember, in the grand scheme of things, you want to see price come back into this 1 hour bearish order block. And obviously, over time, price actually came back into this 1 hour order block. And therefore, you could have actually extended your TP to this area right here for a 1:3. Right? Remember, counter trend trades are riskier in nature, and that's why you need to see 4 criteria instead of 3. You need 1 additional criteria, which is the BOS and then the retest to enter. That's it, right? I've simplified my 7 years of trading into these 2 different types of confirmation to ensure that I don't take low probability trades. All right, so this is exactly how a counter trend trade would look like, especially after creating a 1 hour bearish change of character. 15 minutes starts to reverse, and you're looking to take the counter trend trade. This is how you can capitalize on it. All right, so make sure to watch this video again and again and again until you understand the confirmation type, so that you will be able to understand how to take advantage of the Asian analysis that I send every single day. And of course, during the London and the New York session, when I give you signals, you will understand why I take the trades I take every single day. And I will see you in the next video.